Looking forward, the jury's still out on inflation, but that recession risk remains significant.
Might take longer for inflation to get back to target.
It's true there is a resilience of inflation which is more tangible in Europe than it is in the US.
Consumers in particular, they aren't behaving like there is a recession in any form coming around the corner.
There's a risk here about a wage price spiral that isn't going away anytime soon.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
$95 crude, live from the City of London for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Counting you down to that Fed decision, two-day meeting begins today down in Washington, D.C. In the equity market on the S&P 500, positive by 0.1%. TK, we go to the commodity market. Right now, Brent, 94.93.
And the quiet of the market and the rest of the market is quiet. I completely take your point. Oil's game-changing here in the last number of days, and it's not $95. It's how we got here. Can you imagine 97? Why can't you extrapolate it out on the edge of $100? Javier Blas's Saudi Light right now is at $100 a barrel.
Up by 0.5%. What does it influence? What does it change? Lisa, I think we've got to ask that question for the Federal Reserve going into tomorrow. Does this change anything for policy, for their forecast into next year?
Ellen Zentner says no over at Morgan Stanley. And then you have Mark Zandi over at Moody's coming out and basically saying it could be a game changer. And then actually saying anything over $100 for any length of time, and we're going to be very sick. So on one hand, you have to think about what this might do in a disinflationary way, but also what this does to goods pricing, as Mohamed El-Erian was saying to you.
Game changer for inflation or game changer for growth? Which one?
It's a great question. We don't really understand. I don't really understand what the major driver here is. Is it the demand side or is it the supply cuts? Is it both? If you have demand holding up, then this is potentially an issue for inflation. If you have this really being driven by Saudi Arabia and supply cuts, which they basically reaffirmed yesterday, then you know what? You could see it really take a hit to growth.
I'm going to dovetail two research notes this morning on this. Lisa, you're out front. You mentioned one of them, Morgan Stanley and Ellen Zentner, John, with a real gap down in presumed U.S. GDP. Ellen goes down 50 basis points, half a percentage point, to almost what's called a full stick down on real GDP. That's a drop. And then to Lisa's observation, Dominic Constam over at Mizuho makes real clear how far are we beyond the pandemic supply economic shock towards traditional demand economics.
So let's work through the calendar. Federal Reserve decision tomorrow. Going through to Friday, we've got a new deadline. Let's talk about that deadline. Noon Eastern on Friday. This from the UAW president. He wants to see serious progress by then.
Yeah.
He had this to say: either the big three get down to business and work with us to make a deal, or more locals will be called on to stand up and go out on strike. Lisa, are we inching towards a bigger, a more prolonged strike here?
Well, it's unclear what negotiations have actually been going on so far. So yesterday we were talking about $21 from Stellantis, and now it comes out that had been offered before the strike was waged. There has been no progress made and no new offers from the auto manufacturers, according to the UAW. Unclear what the threshold is to mean serious progress at a time of these kinds of negotiations.
It's an original path, and I'll be honest, like you, Lisa, I just simply don't get it. What's the auto response? And can we just say that we're in early days of it could be weeks or months? I don't know.
It feels that way.
Yeah.
The Detroit Three just looked dazed and confused.
We mentioned NHS and the doctors here in the United Kingdom. Times of London this morning. Are they going to order the junior doctors, the interns and residents back? Here, there's a story. I'm not sure what the story is in America.
It's a very different labour market. Yeah. Lisa's going to go through the day ahead for you in just a moment. Just to touch base and give you a snapshot of the price action currently. The equity market elevated by 0.1% on the S&P 500. Still in the 430s on a 10-year. Yields up by a single basis point, 431.66. Lisa, crude, WTI, 92.63, up by 1.26%.
Yeah, the big mover is everything else is in stasis ahead of the Fed meeting. Today, President Biden is heading to further clog up traffic in New York City at the UN General Assembly. He's going to be speaking reportedly this morning at some point. Curious to see how he tries to imbue this event with some relevance, as a lot of major leaders of other nations did not show up. Then at 1 p.m. Eastern today, we do get U.S. Auctioning off $13 billion of 20-year notes. These tend to be messy auctions. bonds. Very curious to see what this does to longer-term bond yields at a time where you already see it creeping towards some of the cycle highs. And today, there's so many meetings and conferences on the sidelines of the UN General Assembly. I mean, it's just all these sort of, yes, exactly.
Yes.
Bilats. Would you like to have a bilat with me?
No, the bilat this afternoon.
Isn't this our regular bilat?
The bilat
Isn't that what this is?
The UN this
Televised
afternoon.
bilat.
The UN this afternoon, the bilat is Newcastle AC Milan. That's
is that
the
so?
bilat.
Are you coming round to my room? We're going to watch that together.
I got to go to the dark side of the boys from Arsenal. Over to
You
the
can
bar.
go to Janet Yellen's room because she's holding a bilat. Actually, she's speaking at 4:05 p.m. Eastern at the Transition Finance Action Forum. There also are other speakers, including European Commission President Ursula von der Leyen, HSBC CEO Noel Quinn. Very curious to see what the word is on China, because you have the German Bundesbank coming out yesterday and saying it's really China that's the cause of our problems. It's our dependency on China. And Janet Yellen yesterday said there is no way that the U.S. and China can decouple. You put these two ideas together side by side could make for some interesting tensions.
Something tells me Noel Quinn's not going to come out and say the problem's China over at HSBC.
Probably
right?
as a safe bet.
Yeah, I think that's a safe bet. The complaints about traffic in New York yesterday, text after text yesterday, Manhattan just an absolute mess.
It was a mess before, and then it's worse.
Nuts. Matt Miller, my good friend, Matt Miller was meant to be covering the Open for me back in New York City. He forgot that the UN General Assembly was on, drove his Porsche into Manhattan for the UN General Assembly and almost missed the top of the show.
Okay.
Isn't that classic Matt Miller?
Are you having Schadenfreude? Yes. Also
Classic
that it's a
Matt
Porsche.
Miller.
I mean, come on, really?
Classic Matt Miller. It's a problem. Jennifer McKeown, Chief Global Economist at Capital Economics, joins us around the table. Jennifer, good to see you in person. This is lovely. $95 crude is not lovely. How much of a problem is that for these three central banks that make decisions this week?
Yeah, it's absolutely a problem, but you're right to point out that it's a problem both for inflation and for growth. And which one do you worry about? Which one do you think about?
Which one do you worry about?
Inflation at the moment, particularly from the Fed's perspective. It doesn't look like we've got a major issue with the economy at the moment. The economy has been relatively resilient, surprisingly so. The real concern, I think, is that this feeds into inflation expectations and starts back off kind of a wage price spiral that we hoped was gone in the US and was fading. I think for now, it's not a major issue, it's not a game changer, but it's certainly something they'll have their eye on.
The theme today of OECD in Paris coming out with a global readjust, and we're going to speak to them later, a very important conversation, but let's get out front. You people write incredibly trenchant notes, broader 60,000 footnotes. I want you to talk to our audiences in America right now about the worry of an outright global slowdown. How far are we? Alarian years ago told me 3% GDP or lower is a global recession. Are we there?
We're certainly in a period of global economic weakness already, I would say. We know that the Eurozone has been stagnant for a while. Germany's in recession. UK has just had a fall in GDP. The US, I think, is a relatively unusual example of economic resilience. China, too, really quite soft. So I don't think we're in a recession, but we're in a period
So what's the strategy to get out of this? My strategy is this really isn't in the textbooks. It's sort of new territory, granted World War II and World War I and all that, but in this new territory, what's the combined strategy to get out of it besides FaceTime at the UN?
Yeah, it's extremely difficult. I think a lot of our economic models just aren't working now. The pandemic's just thrown them into disarray. We don't really know where the economy stands, where any of the major economies stand relative to their potential, so how much inflation pressure is being generated, which makes it very, very difficult for the central banks, which I think is why they're just very much data dependent at the moment, watching to see how hard the tightening that they've already implemented is hitting their economies and whether inflation pressures are fading.
Which is the most important central bank meeting for you that we're going to get over the next 4 days? We're going to get the Federal Reserve tomorrow, the Bank of England on Thursday, and a whole host of others, and then the Bank of Japan on Friday.
Yeah, I think, well, the Bank of Japan's interesting suddenly again, but I think the Bank of England more interesting this week just because it's facing a really different situation to the US. Wage growth above 8%. The unemployment rate's coming up, but that doesn't really seem to be tempering wage growth yet. Core inflation still very high. We're looking for tomorrow to see whether core inflation starts to edge down. If that doesn't happen, if we see another rise in core inflation in the UK inflation data tomorrow, then I think we could be looking at a 50 basis point hike. At the moment, we're penciling in 25, but I think that's where the risk lies.
What would the response be like to a 50 basis point rate hike?
I mean, well, it would come as a surprise, but not a complete shock, I don't think. It's pretty clear that there's a major inflation problem in the UK, but that's tempered, of course, by the fact that GDP fell in the latest data. So I think the Bank of England is going to try and look a bit forward and assume that this will start to bring inflationary pressures down, but with the oil price so high as well, with wage growth still very high, it wouldn't be that surprising if it decided to err on the side of caution.
Dominic Constam over at Mizuho talks about a fast and deep cut once the Fed goes. Do you agree that the glide path of monetary accommodation, I mean, we've had so little history of this in the recent decades, can it be fast and deep when the central banks blink and go?
Yeah, I think in the US case it probably will be next year. I think for the US.
What about in the euro? I mean, John's been better at this than me, but the euro on a nominal GDP basis, where the euro ECB is just extraordinary. Can they cut fast and deep?
I think it's less likely for the ECB, unfortunately. Wage growth has been really sticky historically. It's been sticky and low previously, but I think now that it's increased,
this
there's
is
a real
not a
risk.
small matter, John.
Bank of France governor spoke earlier on this morning, said we have the right dose, but we have to take the medicine for a sufficiently long time, and we will see the deceleration of inflation. When they say we have to take the medicine, if it's not a recession in Germany and stagnant growth, what does that look like in Europe?
Yeah, I think unfortunately it's just for longer and illness for longer to bring down these inflationary pressures. The ECB, this is really familiar rhetoric from the ECB recently, that it seems like they're at the peak. We think they're probably done hiking, but that it's going to be a relatively long period at that higher rate, which the Eurozone is really not accustomed to. So it will be interesting to see and difficult to tell.
Deutsche Bank called this a low conviction pause, I think. Is that what you would call it? And when I say low conviction pause, I don't mean that cuts are about to come, that maybe more hikes are.
Yeah, I think that's probably right. We're not expecting any more hikes, but I think if you see core inflation rise again in the Eurozone, if there's any evidence that this high oil price is starting to feed through into wage negotiations, then absolutely you could see another hike from the ECB.
We say this every single morning at the moment, TK. What a difficult moment for the Europeans, for the ECB, given this backdrop at the moment.
The fancy talk at UCL that Jennifer would know is they don't have the degrees of freedom that the United States has. And the United States has it because of innovation, technology, somewhat demographics, even somewhat immigration. And over here, they just don't have those impulses.
Jennifer, thank you. Jennifer McKeown there of Capital Economics. We need to build on this as well. New forecast from the OECD. Bramo, growth's going to ease to 2.7% in 2024 from a already subpar global growth expansion of 3% this year. The OECD had this to say: while high inflation continues to unwind, the world economy remains in a difficult place. We're confronting the double challenges of inflation and low growth. Lisa, we're going to catch up with the OECD chief economist in about 5 minutes' time.
And really, this raises a question that we were just talking about with Jennifer McKeown, which is, what is the role of central banks? What is the role of rate hikes at a time of stagflation? How far do rate hikes have to go if they're not working?
They become overcome by events.
Well, but at a certain point, how effective are they if some of the inflationary pressures are being driven by things other than the flow of money? That, to me, is a real conundrum that the ECB is facing right now.
It varies country to country, but what I would suggest is OECD was out front in this, and the IMF this morning. Pierre-Olivier Grenache at the IMF looks like a genius this morning off of that April World Economic Outlook, where they really struck people out to 2028. What I find fascinating is, how do we get to 2026? Is it the same growth model or non-growth model?
Have you seen the call from AllianceBernstein? 2.5% on a US 10-year. We've spoken to some bulls recently, Morgan Stanley, BMO, Wells Fargo. 2.5% is a new one.
Well, and Ellen Zentner thinks that the next move for the Federal Reserve is going to be a cut in March of 2024. So if you start talking about the potential for rapid deceleration, that means the lag effects haven't taken effect, and you're going to see them.
We'll have to revisit that to the Fed show tomorrow, but there's a whole set of disinflationist, I can't get it out.
You've got it.
Disinflationistas.
Bramo, don't help.
Hold on a second. What was that? What was that last one you did?
When has he ever helped us? What are you doing?
I'm trying to be nice. I'm
Coming
London
up
nice.
on those OECD forecasts, Claire Lombardelli, the OECD chief economist, on their interim economic outlook. Live from London. Good morning.
It's also, in many areas, a win-win relationship in the sense that our trade and investment flows produce gains for China and gains for the United States. And much of it is uncontroversial, should thrive, and it would really be disastrous to try to decouple from China.
It's not decoupling, it's not de-risking anymore, it's diversifying. Treasury Secretary Janet Yellen speaking at a fireside chat at the Clinton Global Initiative with the former Secretary of State Hillary Clinton. We're diversifying, Bramo.
Yeah.
We're not decoupling. Has the administration said it enough times to believe it yet?
What does it mean? I don't really understand what we're supposed to believe, because right now it's not very clear what exactly the marching orders of diversification really are.
Decoupling. They're scared of saying that word now, aren't they? Decoupling.
It is a very confusing time for policy between the U.S. and China at a time where you can't just make a sudden fissure, and you don't want to start a war, but you have to somehow deal with the fact that there is a rising amount of geopolitical risk. I mean, the Bundesbank went straight at it today.
Let's pick an industry. EVs. Are we decoupling? Can we decouple? Can we decouple those supply chains?
I mean, if Tesla were speaking about this, if Elon Musk had anything to say, no way. This is something that's absolutely instrumental to his business.
The German manufacturers?
They are going to say, we're scared, we don't know what to do.
Precisely. And the US right now, can we please just have some kind of contract negotiation with UAW, because it feels like no one's at the table anymore. TK, the Detroit 3 have got a new deadline. It's noon Eastern on Friday. The UAW president wants to see serious progress by midday on Friday, and if we don't, this strike gets bigger and maybe even goes on for longer.
Next? Who's next, I think, is the big thing. Lisa had that chart a couple days ago of increased strikes in America, and it's back decades. I mean, where we are, I don't think we realize how, it's not that this is original, but we haven't seen it for 20, 30 years.
I'm not just thinking about people who are in unions, TK. I'm thinking beyond that. The signalling effect that you get beyond this. A 20% offer over 5 years, 4 years. And Lisa, at the moment, there is just pushback after pushback from this union. What's the signal effect you get from that, away from union membership, just to an everyday worker who's going to go sit down with their manager at the end of the year? What does this do for those negotiations?
Jeff Yu from BNY Mellon said it really well yesterday. And he said, basically, the union is gambling. The labor market is still very, very tight. And that is the question. If the rank and file outside of unions feels the same, that their job is crucial to their business and cannot be replaced, well, then they will go in there and say, look what the UAW is getting. We want a piece of that, too.
TK's taking notes for his year-end evaluation. Equities on the S&P 500 here, positive by 0.16%. There's a little bit of a lift here. It's a quiet start to the week on Monday, arguably a quiet start on Tuesday as well, going into the Federal Reserve tomorrow. 431.46 on a 10-year, yields up by a single basis point. Earlier on today, $95 crude. At the moment, WTI's at 92.75, we're up by 1.4%, and the euro totally unchanged, just in at around 107, 106.94. Some fresh forecasts this morning from the OECD, forecasting global growth will ease to 2.7% in 2024, marking the weakest annual expansion bar the COVID-hit 2020 since the global financial crisis. The OECD writing this after a stronger than expected start to 2023, helped by lower energy prices and the reopening of China. Global growth is expected to moderate. The impact of tighter monetary policy is becoming increasingly visible. Business and consumer confidence have turned down. And Tom, the rebound in China has faded. So the tailwind at the start of the year has turned into a headwind at the end of the year. Crude and China, two of the aspects of that call.
These global institutions in Paris, the OECD, the IMF in Washington have been out front on this. I'll be honest, folks, they've really done a bang-up job of being cautious about a global post-pandemic boom. Joining us now, highly qualified, is Claire Lombardelli, OECD chief economist, who has done her work in the crucible of United Kingdom economics, which is worst job on the planet. We welcome her this morning. Claire, I'm absolutely fascinated if you can extend out your caution into 2026 and 2027. Pierre-Olivier over at IMF was able to go out to 2028. Can OECD get halfway there and move out into 26 with a global caution on growth?
Thanks, we're not going to give you forecast numbers for those years, but what I can tell you is that what we're seeing at the moment is weak growth. We're seeing it this year, we're expecting it next year, and without policy change, actually, we don't expect the levels of growth to pick up rapidly in terms of what we need to see in medium term to get economies growing again.
We have scheduled later this week David Folkerts-Landau of Deutsche Bank, and he's made real clear fiscal stimulus and a reach beyond austerity is important. You've lived it in the United Kingdom. Are we being too austere? Do we need a global fiscal stimulus at this moment?
No, we don't think that's what the global economy needs at all. In fact, it's important that fiscal policy works in collaboration with monetary policy and certainly aligns with it and doesn't conflict with it. What economies really need to get growth going is structural reform. It's changes to things like trading patterns. We need to, trade should be driving global growth, and we're just not seeing that at the moment. We also need countries to be undertaking structural reforms to get more of their people into work, extending working lives. We need to be invigorating reallocation across economies. It's structural reform that can drive growth, and that's what we're recommending.
What the OECD is describing today in their report is basically stagflation. And it's something that's concerning at a time when people are wondering, how do we get out? And whether monetary policy is the effective tool to do so if it hasn't been as effective as people expected to this point. Claire, do you think that monetary policy has the same effect on inflation in a stagflationary type of environment where price increases are being driven by things outside just simply the flow of money?
No, we're not predicting stagflation. I mean, we've got low growth. You're right, growth is low, but there is high inflation. And actually, we are seeing that monetary policy is working. It is working its way through economies, and we are beginning to see the tide turning on inflation. Headline inflation is coming down in some countries, also core inflation. I mean, you're right that there's a lot of uncertainty around monetary policy at the moment, quite how powerful it is, quite how long those lags will be, as you might expect, given a very long period of very low rates and very low inflation. Now we're seeing monetary policy act. It is harder to judge quite how powerful that is and how far it needs to go.
On a policy level, on a fiscal policy level, how important is it to your forecasts to see some sort of, let's use the Biden administration's word, diversification of supply chains, or what we're seeing from the Bundesbank yesterday saying that one of the main risks to the German economy is its interconnectedness with China? How much is that your base case, a diversification, or to use another word, decoupling with the Western world and China?
So we are not forecasting a decoupling, as you call it. What we are worried about is the amount of trade that we're seeing and trade intensity, which has stopped growing, particularly in goods. We've seen a real slowing in the increases in trade, and that is a worry, and we would caution governments from going further in that space. Of course, there are issues around security concerns, and it's right to think about that. But actually, the vast majority of trade, we should be seeing greater trade integration. There's a lot more scope for services trade. Those can really promote growth, can promote prosperity, and that's what we would encourage.
Claire, appreciate the update. Thank you. Claire Lombardelli there of the OECD. This call on monetary policy is an interesting one. Limited scope for any rate cuts well into 2024. That's the call from them, Lisa, well into 2024. So all these calls about Q1, Q2 of next year, they're pushing it right the way out to the end of next year.
Which is what we heard from the French central banker earlier this morning. I don't know if that's applicable, though, in the United States. And we heard that from Jennifer McEwen. We heard that or read that in Ellen Zentner's note, where she expects the next cut or the next move to be a cut in March. Is it different? Is the disinflation somehow more powerful in the U.S.? I don't know. I don't know if we're going to see a change because of oil prices and where they are now.
Well, I don't think we think that all rate cuts are created equally. What are we cutting rates for? Because inflation has come down a bit and they want to maintain restrictive levels by basically focusing on the real rate, one. Or two, growth just collapses and they've got that space to cut more aggressively, which is what Tom indicated. I think we need to get into that. When you get the rate cut call for next year from various banks, Lisa, why is it? Because not all rate cuts are equal.
If you have it because growth is collapsing, that's how you get to Alliance-Bernstein's 2.5% on the 10-year.
250.
Exactly. So this is sort of what we're looking at with some people gaming that out.
Max Kettner, HSBC, around this table. He got it right this year, big time. He was bullish, constructive on the outlook. Has that outlook changed? The man from HSBC is just around a corner. Equity futures on the S&P 500 positive here by 0.1%. Live from the City of London all week. This is Bloomberg Surveillance. Take a sneak peek at a price action just briefly. Equity futures on the S&P 500 positive here by 0.1%, a little lift. I'll keep this brief. Got a fantastic guest around the table with us. The Nasdaq up by 0.1% as well. In the bond market, 2-year, 10-year, 30-year shaping up as follows. Your 10-year came within a basis point of a cycle high just yesterday. 431.26 this morning, up a single basis point into the Federal Reserve tomorrow. The euro just short of 107 this morning, 106.95. Positive 0.04%. I want to get straight to it. Under surveillance this morning, it's this one. It's in the commodity market. It's crude. Extending its rally with Brent, touching $95 a barrel for the first time since last November. Crude surging more than 25% over the past 3 months on the back of supply cuts from OPEC+, leading to a flurry of predictions that the global benchmark could hit $100 a barrel this year. One of those predictions around this table, TK, just yesterday, and Rita Sen of Energy Aspects saying triple-digit crude by Halloween.
Yeah, but it's a different $100 than the last time we were there. This is based on post-pandemic demand pickup is the heart of the matter. I know the focus is on Saudi and supply dynamics and that, but this time is, I'm going to go with the this time is different camp, and everybody's got to adapt and adjust to that. I'm going to guess Neil Dudd is going to say, you know, the world's not going to end. We'll get used to it.
What I find interesting is when you read some of the commentary, there is a belief sort of the way that there was about inflation being transitory. There's sort of a same kind of belief in the oil community about energy prices, basically saying this is only for the November contract. But then if you look out further, you can see that they actually do come down because this is being driven by Saudi Arabia. If it is proven that it is being driven by something more demand driven, the way that you're talking about, Tom, there might be a different, more sustained response in markets.
On a microeconomic basis, high prices will solve itself. You bring it up, you get $5 a gallon gas, you get $9 a gallon petrol in the United Kingdom. That's going to solve the problem. Demand comes in. But what about EM? What about a burgeoning post-COVID Asia? That's what I would watch.
Tom, you're far better at this than I am, but energy demand is fairly inelastic, isn't it?
Yes.
Fairly price inelastic.
Yeah, particularly down to the distillates, which
isn't the trade-off elsewhere?
Yeah. No, it's hugely inelastic, and Amrita Sen and others would say if you got to get away from the financial media focus on the fixation on WTI and Brent, and look at the Steve Shork world, you know, the distillates diesel. And all that.
And diesel prices are shooting higher, Bramo, in a much bigger way. Chevron interview, Mike Wirth, Alex Steele, Guy Johnson, fantastic yesterday. You should take a look at that if you can on Bloomberg.com. Can we live with triple-digit crude? Want to get to this story. UAW imposing another deadline on labour talks with Detroit's big three automakers, saying it will expand its strikes at noon Friday if, quote, serious progress isn't made in negotiations. A union rep, Lisa, said no new offers had come in since it made proposals on September 14th. The union is seeking a 36% pay raise, Stellantis offering 21%, Ford and GM offering 20%. Do you want to define what progress is by noon Eastern on Friday?
Not particularly, no. I don't want to define that. Any other questions? I mean, this is the issue, is that we have no idea what that means. We don't understand what exactly is actually going on with respect to the negotiations, whether there have been new offers put on the table from Ford, GM, and Stellantis. And so at this point, is this basically carte blanche to expand something and prolong something that some people are trying to game at? I'm just going to keep talking. That people are trying to see, you know, will this have an effect on inflation as well as potentially on growth?
It's an odd skill on Bloomberg Surveillance, isn't it? Just to keep talking when Tom's interrupted. Story of the last 24 hours. We have questions. Search teams finding wreckage of the missing F-35 fighter jet that mysteriously vanished on Sunday. The jet disappeared after its pilot ejected from the aircraft during a training mission in South Carolina, leading to an extensive search that involved teams from the Marines, Navy, Civil Air Patrol and local law enforcement. The debris was found around 80 miles northeast of Joint Base Charleston. Tom, we have questions. One is, how on earth did this happen to begin with, and how did they lose track of it?
Engineering, they lost track of it. The transponder, whatever it's called, went out. And, you know, they found it a couple of days later. I got to admit it's odd, but what's more disconcerting is the grounding of jets, and I'm not informed on this, but there's been a series of accidents with $80 million pieces of hardware. That's what I would focus on.
Okay, the $80 million, that's what I want to focus on.
Well,
it actually could be $180 million, some of these aircraft.
Yeah.
If you look at the actual F-35 program or this particular type of plane, it's like insane. It's like $450 billion contract that the U.S. has to develop these planes. So you have an accident, oopsie, I think I just blew $100 to $200 million.
I look at the aircraft and I go, you know, the truth is out there, but so are lies.
I'm sorry.
X-Files.
X-Files. What are you suggesting happened here on Sunday?
I don't know. Scully knows. Mulder doesn't know.
Move on, CK. Let's get to Max.
Joining us now is someone that makes you lean forward. It is multi-asset strategy, but mostly he is Senior Vice President, Courage to Stay in the Market at the Hong Kong and Shanghai Banking Corporation. Max Kettner darkens the London door today. What is your new outlook? What is the nuance of the last few weeks as you look forward into 2024?
You know, I think some of the nuances you guys were talking about already, right, is oil prices, energy prices. Perhaps that changes a little bit of the narrative, right? That perhaps inflation does pick up a bit more in the US, right, towards Q4. So that's not particularly great news for a Goldilocks scenario. I think the nuances is also going into Q4. What can destroy that Goldilocks picture, right? Because we're all talking about all these horrible things, right? Like, you know, things like student loan repayments and are we hitting recession and all these things. And then we look at high yield spreads and they're just going towards 350 and happy days for everyone, right? Great. So I think the nuances are sort of trying to find out what could potentially break all this, right? What could potentially break that sort of Goldilocks scenario.
Is $95 crude it?
No.
You don't think that could break this?
I don't think so. It's one nuance. I think it's one of those where, to be fair, if I was the Fed, if I was the ECB or the Bank of England, which, you know, lucky for everyone that I'm not, but, you know, if I were, I'd be basically saying, well, what should I do about that, right? What can I do about it? I mean, I'm not an oil producer, so I can't really do anything, and I can sort of use it as saying, look, this is just energy prices. It's something transitory. It'll be going away out of the calculation within a couple of months. Don't worry, right? All the other rest, you know, excluding 15 components from our preferred inflation baskets, then everything looks fine. So I think that's the worry that I have, right? That if we start looking at these inflation baskets that sort of exclude everything that we need for the everyday life, that they're starting to pick up again. And to be fair, if you look at things like super core inflation, right, the action components, the broad-based nature of it hasn't really dramatically changed over the last 12, 18 months. So that is perhaps something towards Q4 where perhaps inflation does pick up beyond just energy prices. Not a new inflation wave, but basically an interruption from that, okay, inflation has gone down in one straight line now, to actually now we're getting sort of this bumpy road ahead, right, in inflation, where we've got to play those turning points.
Max, the question everyone wants us to ask, are we still in a window where you think equities can do well?
Oh, yeah, 100%.
Until
100%.
when? How big is that window?
100%. Look, to be perfectly honest, if we think about it, and I know it sounds stupid, but imagine if yields go up. Imagine the 10-year goes to 4.5. What's the reality? The reality is it's probably going to do it because growth is better, right? And because, once again, growth expectations actually turn out to be too pessimistic, right? If you look at Q4 US growth expectations, it's sort of zero. Q1 next year is also close to zero. So the bar to beat is relatively low. So if you get yields moving higher, that's probably in response to growth doing better, so you buy equities. If yields go down, right, then probably rates vol goes down, and then you buy the NASDAQ. So to be fair, yeah, great, I'll just buy equities.
Can big tech still lead, though? And we've seen a recent kind of weakening in the tech profile and an underperformance there. Some people are saying this is the beginning of the end of the tech trade. Are you on that train?
Well, we've heard that for, I think, 15 years. So, you know, it's been a lot of beginnings of the end. Now, look, I don't want to be too cynical, right? But
last year was pretty brutal for the tech trade. Let's be clear.
So, but to be perfectly honest, I think tech still has a bit of room to go in the next couple of weeks. There is probably a window around Q4 where I'd be moving more towards really the value side of things, right? Tactically, right? If we get that bump in inflation, particularly in the US a bit higher, you want to probably prefer then for a couple of months things like banks or energy over tech. But for now, I think energy still has, or tech still has a way to go.
You mentioned all of the dark clouds, including people repaying their debts, and also this question around a government shutdown, which seems like an increasing inevitability in the U.S. Amid this backdrop of strikes and a question of just general dissatisfaction. Which of those kinds of things do you care most about? Could actually have the most impact on your call?
Look, I think the government shutdown, not really, right? Because we kind of got used to it every other quarter. So from an equity perspective, I know it sounds depressing, but if we're honest, right, it was a shock 12 years ago. It's not particularly a shock anymore, right? So from an equity perspective, from a risk asset perspective, that's not the main worry. The student loan repayments also not particularly worried about it, because you can also make a positive spin out of it, right? You can also say, look, actually, from the end of July up until now, repayments have shot higher because actually economic agents, i.e. normal people like us, they're acting completely rationally, right? They're seeing that, okay, this is starting to kick in. So instead of starting to, or having to start to actually pay interest on it again, I'm going to repay it early. And guess what? I have the money, so let me repay as much as I can. So actually, you can also make a positive spin out of it, right? And say, look, people apparently still have the money to do that, right? They still have sufficient money to do these pretty chunky repayments early. So all of that doesn't really keep me that much.
A quick question here. Can you frame out SPX 5,000? I got to make some news today. I got to justify the trip to London. Can you give me 5,000 SPX?
I think, if we think about next year, to be fair, it's not an awful lot away, right? It's 10-12% away, right? And if we're thinking, if we're still in a fairly high-ish inflation environment, right, and earnings growth is still relatively fine, yeah, why not?
Noel Quinn's all under today. He's doing something with the United Nations. I'm not sure what it is. Noel Quinn listens to Max Kettner. HSBC is a prism to Asia like no one else. I personally witnessed it across that little Hong Kong trolley in Asia. How do you link China trauma, and particularly domestic trauma, into all the toxic brew of gloom in the West? How do you link Hong Kong and Shanghai over to London and New York?
Look, I think what's very clear with regard to Europe and with regard to China, and now a little bit less in the US, is, like you've said, there's all this doom and gloom, right? There's all these expectations around doom and gloom. Right. I don't think you guys have had any guests on probably for weeks who are saying, look, you know what? 2023 has been better than expected. We were a bit wrong, right, on Europe and on the US, but guess what? 2024 is going to be even better, right? So I just genuinely cannot see how we're going to get, start to think about 2024, how we're actually going to see 2024 outlooks where people say, look, you know what? China's going to do great, Europe's going to do even better, and US is going to shoot the lights out. I just cannot see anyone doing that.
So do you want to take the other side of that?
I want to take that side, yeah.
Really?
The thing is, right?
So you're giving us a 24 call right now?
No, look, the one thing that I am not asked at all about, and for months, is what could actually go right.
What can go right next year?
What can actually, in the next 6-12 months,
3 months.
What's actually one thing where we could be saying, hey, you know what? Maybe
I'm asking
things
you, Max,
are not going to fall.
Let's go.
So what is the answer?
So the answer to me is, as long as we still have these really low growth expectations, you have a low bar to beat, and you keep rolling Goldilocks and Goldilocks and Goldilocks. Right? It's great.
Goldilocks forever into 24.
Yeah.
Okay.
I think it is a lonely call. I mean, we're busting
incredibly lonely.
But it's a really...
I'm not saying it's the wrong call. It's not for me to say it's the wrong call, but
line them
it's
up.
lonely.
Binky Chowd at Deutsche Bank, Max Kettner at HSBC. There's a couple others out there,
Max has been right. I think we should put that out there first. You've been right all year, Max. We'll see about 2024. That's quite a call. Max Kettner there of HSBC. The annual outlooks are going to start coming through in about a month, isn't that crazy?
They are. They're going to be exciting.
They start to write.
Can we go to the news that matters?
I'm just going to Goldilocks forever. Yeah.
We got to go to the news that matters here, and this is really pretty cool. The guy with Newcastle is walking into San Siro tonight for the first time ever. John, what is it like to walk into San Siro in Milan?
Amazing.
Well, let's expand. This is a big deal, folks.
It's just a cauldron of noise. It's just a cauldron of noise.
It's a different culture.
Three tiers just hanging over the top of the field, 80,000, 90,000 fans. That roar in there is so unique. I get emotional in that stadium.
This is poetry.
It's
a cauldron of noise.
I get emotional in that stadium.
He's so damn emotional. He's extending his trip to London next week just so he can go to the Derby on Sunday.
I got messages last night actually saying, why aren't you on a plane? Like, why aren't you on a plane to Milan for the game? I know. Because I want to talk to Will Kennedy about $95 Brent next on Bloomberg TV and Radio.
An average of 92 does allow oil prices to go to 100. We're putting out a piece later today, which is calling for $100 by Halloween for Brent. And again, this is just a trajectory. And at this point, look, of course, it's a short-term thing, right? I'm not saying it's going to average above 100, but could it go to $100 for a bit? Absolutely, yes.
How big is your team?
Triple-digit crude by Halloween. Amrita Sen, founder and director of research over at Energy Aspects. This morning, 95 on Brent. Right now, WTI 92.62. The price action elsewhere pretty muted. Unchanged on a 10-year in America, 430.86. We're unchanged there on a 10-year. On the euro, slightly stronger, 107.05. Just about reclaiming 107 in the last 5-10 minutes or so. And equity futures, Tom, elevated, doing okay. It's a quiet start to the week outside of crude, going into the Federal Reserve tomorrow.
Exactly. 3 central bank meetings. Is tomorrow a live meeting, or are we doing definitive coverage for a dead meeting?
The decision is dead. The forecasts are alive. Does that make sense?
The dots.
No one's expecting a rate hike tomorrow, but changes to the dots, changes to the forecast, inflation growth this year, and perhaps next year
too. If I'm carte blanche, it's like, où est le dot medium?
Does the median dot come down for 23?
Sorry, like that French there?
Where does 24 go? And what about that longer-term dot as well? Do you start to think about kicking
interesting. Tune in. We're going to be here tomorrow in London, all with our usual guests. Really, we're going to do the quality show we can, and not only to get you to September, but to get you to November tomorrow as well. This is a joy, and I'm going to take a little moment here to do this. The founder of Bloomberg News a few years ago, Matt Winkler, said, okay, what can we own? And he went to a guy named Stuart Wallace, who's a really odd guy. Like, he's a different guy. And he said, Stuart, build it up. And Stuart Wallace constructed, through airline terminals and the rest, a hydrocarbon team that is definitive in the world. Stuart was exhausted and said, Will, it's yours. Joining us now, Will Kennedy, running all of our hydrocarbon in order. How many people are involved at Bloomberg News and looking at oil and gas?
Oil and gas, probably about 60 to 70 worldwide. 60
to 70 worldwide. Alex Longley's got the thing you're focused on right now, away from what's Brent going to do, what's West Texas Intermediate, is all the different grades of oil, the not in my backyard refineries and that. What's the observation our audience needs to know about what Alex Longley's working on?
I think the thing to see is we're looking at futures prices here, and clearly that's the price that matters. But when you look at the underlying parts of the oil market that Alex and those guys are reporting on every day, you're seeing a very tight market. You're seeing a lot of demand for Middle Eastern crude in China and the rest of Asia. You're seeing a lot of demand for US crude. You're seeing that oil today is worth considerably more than oil in the future. That spread is as elevated as it's been in a year. And you're also seeing a refining system that's stretched, and stretched because demand for diesel, for gasoline, for jet fuel is looking really strong. So that means that the margin between crude and fuels is also wide, so what people are paying for what they use. So you're just seeing an oil system which looks tight.
So what Lisa brought up earlier, the elasticity or the responsiveness of the demand side of oil, all of that covered by a post-COVID Asia. Our Asia team of those 60 and 70 people, what do they say about the elasticity of Asian demand?
It's this is not quite the elasticity you had in mind, but it's bounced back. And I think that people were worried about Chinese demand in particular over the summer months. But one of the things that's driving this market higher is that people see that China demand right now, despite all the concerns about the property sector, despite all the worries about parts of the economy, is fairly strong. That it is bouncing back, and that reflects good demand for in China, where people are traveling a lot. And it also reflects that fact that increasingly the world is reliant on Chinese oil refineries.
So I want to just go back to the point where you were talking about how a lot of the higher prices are near term. Longer term, people say, they're going to go back down. This is basically high oil is transitory, and that is playing out in the commodity sector through the pricing. What has to change for it to have a sort of stickier feel to it in some of the futures pricing?
I think the market right now is looking for where that point is that, clearly Saudi Arabia and its allies in OPEC have sought to take a grip on the market. They're comfortable with prices coming into this $90 to $100 range. If we touch 100, I think the question then becomes, does OPEC let it go higher than that? And at what point does it start to dampen demand? And I think that really hasn't... we saw that in the aftermath of the war when oil went to 120. It clearly did have an impact on demand. But we've got to find that spot between where OPEC's happy and where it starts to really impact demand. And I'm not sure in the current economy people know exactly where that is.
We also don't really understand whether this is really supply-driven or demand-driven. And this is at a point where, yes, people are pointing to the Saudi Arabia production cuts, but there was an incredible amount of demand before that, and inventories had come down dramatically. How underplayed is the demand side of this story as we talk about it?
I think, as I said, when you look at the bounce back in Asia, but you look at more broadly around the world, demand has probably been much stronger than people expected. It really has been quite buoyant. We are well past probably pre-COVID highs now. We're seeing record oil demand day in, day out. And that bounce back has come through a certain uncertainty about the state of the economy. But it does reflect, A, that the economy is strong, and that, B, the economy still runs on oil.
Well, Saudi and Russia have a monthly review. They've cut back. They said those cuts are to be discussed monthly. Do you have any idea of what the line of the sand is for them to say, actually, maybe we should change?
No, I don't. I don't think we know that. I think that's one of the key questions that people have been looking from here on out. I think they will be very alive to demand for their crude, though. Right now, I think they feel like demand for their crude is strong. They're able to charge very healthy premiums for it. I mean, don't forget, as Javier pointed out in the column last week, the Saudis right now are getting well over $100 a barrel for their crude, which is something that people don't.
Let's get into that. I think we should finish there. The Saudi premium.
Yeah.
Are they in a great spot right now to charge whatever they want because there are certain places that can only get crude from them and a few other places?
I'm not sure they'd characterise it as whatever they want, but they are in a good spot now. Their crudes are diesel rich, they're in demand, they're going to Asia. That premium has risen markedly over the last few years, and I think that does reflect the pricing power that Saudi Arabia and OPEC has in the market right now.
Is Russia still on the same page as Saudi Arabia?
Yes, I think that they actually are. I think one thing, rhetorically, they absolutely are. There's been a real effort to communicate together, to show that that political alliance is strong, to show that the leaders of those countries, Vladimir Putin and Mohammed bin Salman, are talking about the oil market regularly. And it is true to say that Russia curbed its exports. Now, a Russian target is not cast iron like a Saudi
target. Well, something
target.
changed, though, right? We talked about this. They moved from volume to price. What was behind that? In terms of the Russians and what they wanted for their crude, weren't they going to export as much as they possibly could, and that's changed?
Well, they are still exporting a norm. They haven't paired their exports like Saudi Arabia has paired their exports. Saudi Arabia is doing more of the work, but I think they thought that it was worth doing some work to cement that alliance with Saudi Arabia, which on an oil market basis looks pretty strong right now.
If I was to get in the Bentley and drive down to Bath, there's a price for a liter of petrol where it falls apart. On a gallon basis, we're emotionally at $4 a gallon to $5 a gallon is a national crisis in America. Where's the tip point on a gallon of petrol? Right now it's about $7.40, I think. Is it $8 a gallon? Is it $9?
Well, we are still European enough that we think in litres, I'm afraid, Tom. And I think that the point where people...
See what I got myself into.
I think the point that people really start to feel it is £2 a litre.
£2 a litre.
Which is where it was after the...
Which means nothing to him. But he's like,
£2 a litre is brutal.
Yeah, I mean, it's well over $8 a gallon, I think.
It's brutal.
Yeah.
And psychologically, the cost of living around, forget the 7 to 8% wage increases, £2 a litre will be the only thing people
The important point about £2 a litre, Tom, is you're spending more than £100 to fill out your car.
Yeah, that's what
and that's what people said. Yeah, that's when people really feel it, is when they go to the pump, they fill the car, it's £100
Is that accelerating the EV transition, Will, or are they just sitting around saying EVs are too expensive, like they are in some places?
There are a lot of I mean, I'm sure you've seen on this visit, there are a lot of EVs in London right now.
Way more.
I mean, it is happening in London. I think the thing is that when you get out to the rest of the country where you don't have the charging points, it's happening a lot more slowly.
Tom likes the electric London cabs.
I like the electric London
just
cabs.
The silence of them.
Built by a Chinese company.
Yeah.
There we go.
Near Coventry.
Yeah.
Is that really? Is that right? Okay.
Yeah.
Nice.
I can't remember. It starts with an A.
Okay, find out. Will, thank you. This was great.
We got through
Always
this tots free.
Kennedy.
We got through this.
You want to squeeze
free.
in some tots?
Yeah, they're rocking it. I mean, they're doing great. I mean, they could take.
Great start to the season.
Are you staying for the match?
We're trying. Ferro's working this thing. He's 24/7 on this. John's home at night on the phone.
Trying to figure it out this weekend.
7 people trying to stretch the trip into Monday.
But our connections with Arsenal, Arsenal are the
you brought up a sore topic.
Are the home team, right? So our connections with Arsenal not as great as our connections with Spurs.
I have a very
so we've got to get tickets to the Emirates.
Neil at the cigar place is all Arsenal all the time.
Can Neil get tickets?
Yeah, you know.
Kit Jukes might be able to get tickets. Have we got Kit on this week?
I don't know. I hope
we should
so.
get Kit on this week.
Now we
just
do.
to ask.
Yeah.
Are we extending our trip?
You can if you want. Okay. Ed Jardine, if
Dr.
Jardine research is coming up. He's been bullish a lot of this year. Let's see if he still is. Equity futures on the S&P 500 positive here by 0.13%. Live from London. Good morning.
Looking forward, the jury's still out on inflation, but that recession risk remains significant.
It might take longer for inflation to get back to target.
It's true there is a resilience of inflation which is more tangible in Europe than it is in the US.
Consumers in particular, they aren't behaving like there is a recession in any form coming around the corner.
There's a risk here about a wage price spiral that isn't going away anytime soon.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
The two-day meeting at the FOMC begins right now or whenever Chairman Powell gets out of bed in Washington. From London, for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Sneak peek of the price action. Equities right now positive by 0.1% on the S&P 500. Main event of the week, Tom. There's three of them, to be fair. The Federal Reserve, the Bank of England, the BOJ. The big one for most is the Federal Reserve, Tom, tomorrow afternoon.
It's going to be interesting to see. And, you know, the way I look at it is with Greenspan, was he having a ham salad sandwich or a peanut butter and jelly sandwich? It was a king. I mean, did they watch what the governor of the Bank of England does when he stops by Greer's? Do they?
We follow the suitcase, the briefcase.
Follow the suitcase and see what's going on.
Communication has changed.
I don't know what to make about it other than there's no other story. $95 barrel oil. And to talk to our guests this morning, including the encyclopedia known as Will Kennedy, we're here.
We're here right now.
And we're going higher.
95 on Brent, Lisa, 92.51 on WTI. We've got questions. What does it mean for the Federal Reserve tomorrow afternoon?
This from Citigroup's Andrew Hollenhorst, just out, basically saying that supply-side constraints exemplified by the auto worker strike, as well as the rise in oil prices, will cast a hawkish shadow on the Fed's meeting. And they talk about this idea for higher for longer that's increasingly getting priced into markets. And if you take a look at Fed funds futures, they are moving up to some of the highest that we've seen for next year, the mid-year next year. People are pricing out some of the cuts that were given earlier in the year.
So hawkish pause, right?
Yeah, well, yes, today, yes.
For Gapen as well, they're looking for another hike potentially in November. Lisa's right, Tom, forget 23, it's into 24. You might get some movement in the dots on 2023. There might be some debate about whether we need one more or whether they think we're done for 23. 24 and the cut still in this market. How much can you push back the idea that we'll get anytime soon?
I don't know. I shut down the Savoy last night, and the band was great. The band was called Hawkish Paws, and they were really quite good.
I'm not sure any band that sounds like Hawkish Paws are playing the Savoy.
Their Coldplay and Adele were just great. So, you know, I'm looking at this, John, and it's just obvious. They're going to be on core inflation, stripped out. What's Mike McKee call it? Super service core. Whatever it is, baloney. Inflation's inflation for the public, and most of the public's flat on their back. Period.
Let's pick up on the Hollenhorst note. So we made 2 points, Lisa. Crude, 95, right here, right now, supply side story. UAW, the strikes there. Let's build on that. There's a new deadline. It is this Friday, noon Eastern. UAW President Mr. Fain would like to see real progress over the next 2-3 days. And if we don't see that real progress, these strikes get prolonged and maybe they are deeper and more severe. Does that mean anything to the Federal Reserve at this point? Can they make a call based on what's happening with UAW and 3 automakers?
I'm going to sound like a broken record. I often do. Jeff Yu yesterday saying that what the automakers are, what the auto workers are betting on is a tight labor market. If they get what they're asking for, anything close to it, is it because this is a tight labor market and there aren't a lot of alternatives, especially if you see other workers taking a signal from this who are not in unions and demanding higher wage increases? That's really ultimately what's underpinning this at a time when jobless claims keep coming in below expectations week after week.
AMH joining us in about 10 minutes' time from New York. We'll touch on that and the latest from the UN General Assembly. Lisa's going to give you the day ahead and all that good stuff in just a moment. Here's the price action. Stocks up by 0.1% on the S&P 500. Bonds essentially unchanged. Yields higher by a single basis point on a 10-year. Tom, we have to talk about a 30-year that was issued a couple of years back, the May 2050 bond. You're going to love what we had to say at Bloomberg News on that story. It dropped below 50 cents on the dollar in yesterday's session. You might well be interested in that particular maturity.
It's on the edge of Austria.
The price story there, Bramo, painful for anyone who picked up that long bond with yields near all-time lows.
Which is the reason why some people are saying now is the year of the bond. Well, there's been a lot of pain to get here. Today, there's a lot of pain that we are avoiding by being in London during the United Nations General Assembly in terms of traffic. President Biden will add to that today. In his address of the UN General Assembly this morning, curious to hear what he has to say about China, about global cooperation, and the fact that there are a lot of questions around the relevance of the UN at this point where there's increasing divergence in the world. 1 p.m., the U.S. is auctioning off $13 billion of 20-year notes, not 50 cents a dollar, but they will be looking at yields that are the highest going back to 2011 on the long end. And today, there's so many meetings and conferences on the sidelines of the UN's General Assembly meeting. What I'm focused on is 4:05 p.m. Treasury Secretary Janet Yellen is speaking. There also is going to be Ursula von der Leyen of the European Commission and Noel Quinn, CEO of HSBC. China, front and focus. What do they think about the prospect of decoupling?
Yeah.
We know from Janet Yellen. Ursula von der Leyen, maybe a little less clear.
Yeah, Max Kettner wrote Noel Quinn's speech.
Is that what you heard?
Yeah, I heard from Max.
Yeah. I'm not sure how much he wants to talk
on it
about
as well.
China. EV tariffs.
Yeah.
That's what I want to talk about.
Absolutely.
The transition. How do they want that transition to look? Is it all about climate? Is it about industrial policy and domestic champions? US manufacturers, European manufacturers? Or are they open to having low tariffs and just having the cheapest provider, which would be at the moment Chinese EVs?
The answer to that is they want the tariffs, and that's what we've heard, and we've heard that change in tone. This is not about an open market because German manufacturers have been horrified by the progress that Chinese manufacturers have made.
That's all coming up a little bit later. Joining us now is Ed Yardeni, president of Yardeni Research. Ed, wonderful to have you with us on the show. We caught up with Max Kettner of HSBC in the previous hour, Ed, and he said we need to focus on what could go right in 2024. Are you more focused on what could go right or what could go wrong?
My view of 2024 is that could be a better year than certainly 2022 was, or even 2023. Not that 2023 is turning out to be a very bad year. As we know, the third quarter is turning out to be remarkably strong. So all in all, I think that we'll get through a lot of these challenges, and 2024 should be a better year for earnings, with the market doing better too.
Ed Yardeni, you and Ralph Enkenpour have been way out front of this on the October rally, and we've talked about a second leg of a bull market. As John mentions, Mr. Kettner of HSBC shares your enthusiasm. The arch pullback of this is the great moderation over. Is the great moderation over, and does that mean you can't make money in stocks?
Well, I've been really debating in my commentaries about whether it's going to be the great inflation of the 1970s, or it might very well turn out to be the roaring 2020s. And I've been inclined to believe that on a longer term basis, we will see that the 2020s will be a period of tremendous progress and productivity. And I was making that point before the pandemic, and the pandemic sort of got in the way because it really messed up the productivity story big time as people quit left and right. But I think we're making a comeback. I think productivity bottomed actually in 2015 in terms of its growth rate. It was only 0.5% on a 20-quarter trailing basis. I think it's going up to 4% by the end of the decade, which sounds delusional, sounds far-fetched, I'll admit. But those are the kind of peaks we've had in previous growth cycles in productivity, and I think that's where we're heading.
Right. Does a real rate, and some would say a higher real rate, an inflation-adjusted rate, does that impinge on your enthusiasm?
Not really. I think we're going back to normal. The new abnormal was the period between the great financial crisis and the great virus crisis. And back then, interest rates were at record lows. I think we're going back to the environment just prior to the great financial crisis, where the TIPS yield was around 2% for the 10-year, and the inflation premium was around 2.5%. So 4.5% is kind of where the bond yield should be in a return to the old normal, and I think that's what we're doing. I think the economy and the stock market have already demonstrated that they can both live with these kind of levels of interest rates.
So you and Max Kettner seem to be on the same page, and Max came on the show earlier and said, you guys all worry too much. No one asks me what can go right, how good things can be, and that's what they should be asking. But it is my job to worry. That is sort of what I do. So I'm curious, from your vantage point, where does oil fit into this at a time where it's risen 30% since June?
Yeah, well, I didn't expect it. I don't think anybody really expected it. I think the widespread perception was, oh, yeah, the Saudis are going to cut production and the Russians will cut production. But China's weak, Europe's weak, the U.S. is sort of muddling along. And that means that oil prices aren't going to go up as the Saudis would like, but they've been right so far. And so that's a new variable that I've had to incorporate into my thinking. And so just recently, past few days, just to demonstrate that I am realistic and I'm looking at the world as it is, not as I'd like it to be. I did raise my outlook for a recession risk from 15% to 25%. And unfortunately, there is a certain sense of deja vu all over again. We had two oil spikes back in the 1970s. So far, the first oil spike we had last year hasn't caused a recession and hasn't been anywhere near what we had back in the 70s. And I don't think this one's going to be a major oil spike either. I think we are going to find that the demand responds pretty quickly to these price hikes, and it slows down, and oil prices come back down, not dramatically, but at least they stop going up.
What's the break point in terms of when prices of oil really do create a serious headwind and increase the chance of recession?
Well, I think they're already starting to impact demand. It's clearly getting a tremendous amount of visibility in the press. And of course, the price of gasoline is the most visible price of them all. We all go driving around, filling up our tanks, and everybody's seeing that the price of oil, gasoline has gone up dramatically. So I think we're at the point where it doesn't cause a recession, but it causes some demand destruction for gasoline and for other energy products. And that being the case, that could bring the price back down. I don't think it's going to cause a recession, but I think, if we sustainably, if we see the price of oil stays sustainably at $100, $110 a barrel, and the price of gasoline $4.50 to $5 a gallon, I think that could certainly risk a much greater slowdown on the economy than I've been thinking.
Certainly going to cause some pain. Ed Yardeni, thank you of Yardeni Research. The energy providers, the producers, having a decent month for the month of September, as you can imagine. 92.44 on WTI, through 95 early this morning on Brent crude. If you are just tuning in, welcome to the programme. On the S&P 500 right now, we are positive by 0.1%. Yields are a little bit higher by a single basis point, 431.26 on a US 10-year. Coming up in the next hour, Alicia Levine of BNY Mellon on this equity market, going into the Federal Reserve decision tomorrow. Tomorrow, less about the rate decision, more about the forecast for growth, for inflation, for interest rates for this year and mainly for 2024. We'll get into that hawkish pause with her a little bit later this morning. Max Kettner of HSBC was on the programme with us about 20 minutes ago here on Bloomberg TV. And Bramo, what he had to say on Goldilocks. I feel bad because I said Goldilocks forever and now everyone's going to say it was Max, but I guess Max basically agreed that Goldilocks forever means like 2024 and maybe longer.
Did you see me typing the headline for the
Max
newsletter?
Kettner says.
100% Goldilocks forever. Exactly. Nailed it. Here's my thing. I mean, honestly, there is this feeling that people have underappreciated the strength. And now there is a question of whether people are just pulling up their previous forecasts for exactly the same playbook as they had at the beginning of this year that were wrong. And now they're just going to roll them out for 2024. And Max is saying, stop being so gloomy. You're just not getting it.
I am sobered up, remembering my grandmother sitting on the couch after the third scotch, regaling us about the pandemic of 1919. And Ed Yardeni said after that horror, and it was worse than COVID, they had the roaring 20s. And what Yardeni said there about ancient history and productivity, John, how many people are in agreement with him? Very few.
What's funny is if you'd asked me that 2 years ago, I would have said quite a few. and then all of a sudden the inflation shock of the last 18 months developed and people backed away from that roaring 20s call. Equities right now on the S&P up by 0.1%. Coming up next, on a missing, then found F-35 fighter jet, Bloomberg's Anne-Marie Hordern from New York City. From London, good morning.
I don't think we should have a shutdown, but I agree with you that I think it is very likely. And I think the reason it is likely is I think Joe Biden and Chuck Schumer both believe politically it is in their best interest to have a shutdown.
That was the latest from Senator Ted Cruz of Texas, speaking on balance of power with Bloomberg's Anne-Marie and Joe Matthew. Will touch base with AMH in just a moment. Sneak peek at the price action for you this Tuesday morning. Good morning to you. Equity futures just about positive by 0.1%. Yields a touch higher by a basis point or two, 431.86 on a 10-year. The headline this morning in financial markets worldwide, if you're looking cross-asset, it's in the commodity market. It's Brent crude. Brent crude through 95 for the first time this year. Right now, 94.92. WTI, Tom, $92.40.
Yeah, I mean, the West Texas Intermediate to me gets my attention, but to me, the underlying story going into 3 central bank meetings is the resiliency of the equity market. Basically, at 4,500, we've gone nowhere for months. There's been like 18 reasons for the stock market to go down, and on a blended basis away from the big seven, it's been resilient.
It's getting what the bulls wanted, right, which is a better mix of growth and inflation. That will be captured by the forecast probably that we get from the Federal Reserve tomorrow, which is growth expectations a little bit higher, inflation a little bit lower going into year end.
I mean, it's really great. We welcome all of you. We're in London for the week. We've got a credit conference coming up on Thursday. Who's our guest at the credit conference?
Jim Zelter, Apollo.
This is timely, to say the least.
Really timely, yeah.
Why have spreads not come in? And for those of you on radio, we are here affixed to a great scene from our Queen Victoria Street. John, on the break here, you and Lisa were talking about too much optimism on the show today. I'm looking back over at St. Paul's, and you know, I'm just thinking.
Just to be clear, that wasn't the conversation at all, but sure. we can go with that.
But early each day to the steps of St. Paul's, the little old bird woman comes in her own special way. She calls, "Come buy my bags full of crumbs."
Okay. Is there a song?
The world stopped in America in about 1965 when Julie Andrews,
we did Mary Poppins,
Julie Popcorn.
Okay.
And before VCRs and that. Pro tip for those of you with children. This is true of baby Zeke and other little children on our team. Mary Poppins is the longest Disney movie, so you could put it in on Saturday morning and sleep longer.
Just keep it on.
You just keep it on. You play, you know.
Dick Van Dyke.
Dick Van Dyke. Yeah, but back then
really good.
You went. Your
so
sisters,
disturbing.
John.
Why?
Your sisters.
What's my sisters got to do with this?
The scene behind us here.
Bring them into it.
The scene behind John Farrell was seared in our memories from the '60s because you had to go to 10 birthday parties and see Mary Poppins like 10 times in a movie theater.
Okay, I have no idea why we're doing this. I'm waiting for this amazing
it's
segue
a little bit of London.
To AMH. It's all going to make sense in like 30 seconds, except it's not. It's not.
Yeah. Joining us on Washington, Bloomberg, Unga? Is that what we're calling it? Bloomberg Unga correspondent Anne-Marie Hordern joins us now in Washington. Let me just cut to the chase. Pomp and circumstance. She's in New York, excuse me, not in Washington. How dare, it's a major folks pa. French there as well, Lisa, like carte blanche. Anne-Marie, I'm looking at Joe Biden. What's he going to say? I mean, is this first do no harm, or is he going to have an assertive speech today?
Well, President Biden, I think, is really going to make his speech about Ukraine, especially with Zelensky here. And while officials haven't really given a lot of specifics or details about what the president will outline today, Jake Sullivan, his national security advisor, said last week that it'll make up the significant part of his speech today. And I think for the president, there's really an audience of two that he's trying to reach. One is the international community. Remember, at the G20, they really feel like they made an impression with the global south, the likes of India, the likes of Brazil. Brazil's Lula, by the way, will be meeting with Zelensky. That'll be actually a critical meeting to watch on the sidelines of the UN General Assembly. But also back at home, domestically, that CNN poll in early August, it wasn't just Republican voters that had some concerns about sending more U.S. money to Ukraine, taxpayer money to Ukraine. Even though it's a majority of Republican voters, there is this concern. And obviously, what we've seen the White House ask Congress in the House, Speaker McCarthy didn't even include Ukraine aid in this continuing resolution to keep the government funding and the government open past September 30th. So I think this will be a big part of the president's speech today, and there's really a twofold approach to why.
Just on foreign policy, AMH, do you get the sense from speaking to the Europeans, from officials from the German government, that they're on the same page as the United States, as President Joe Biden?
Well, so I had an interesting conversation with Annalena Baerbock, the German foreign minister, on Sunday, and already Olaf Scholz, the chancellor, has come out and said he supports President Biden in a second term. Besides the fact I asked her if that was appropriate, she said that what she is doing now is how they are trying to prepare for the potential of Trump 2.0. And before she came here to New York, she was in Washington, D.C. to meet with Republican lawmakers to talk about and field questions really about Ukraine aid. But also she was in Texas, deep red state, and had a frank conversation with Governor Abbott. So you see some members in Europe are trying to make sure that they are shoring up support and dialogue with Republicans, and they're preparing for a potential Republican administration after the November presidential election. We should note, though, that what is happening in the United States is also happening in Europe. If you look at German politics right now, you have millennials who are actually starting to, some of them, shift towards far-right politicians in Germany as well, the AfD, the Alternative for Germany party. This is a far-right party. And in Germany, individuals are also dealing with concerns about immigration, a ton of concerns about inflation, and you see these conversations also playing out in European politics as well.
Do you get a sense of what the solutions are that are coming from the right, coming from the conservative side of politics?
Well, at the moment, what you hear from conservative politics when it comes to Ukraine is that they do not want to send, some of them, more money to Kyiv. They think that enough of U.S. taxpayer dollars are going, and at the moment, there's still this war raging on. Some potentially are pushing for, is there any sort of accountability? Is there going to be any sort of peace negotiations? But this is only just one part of the Republican Party. You have others like Lindsey Graham, like Representative McCall, like Mitch McConnell, who want to keep making sure that they are sending more weapons to Ukraine,
Right.
they are aiding Ukraine, and actually sometimes bash the Biden administration because they say that the administration is moving too slowly.
Right. Anne-Marie, this is important, and with your reporting, I can ask an unfair question. In World War II, there were too many times, like going up the spine of Italy, where American troops ran out of ammunition. Are we being so frugal that the Ukrainians are running out of ammunition?
Well, I will say the message that I hear constantly from the Ukrainians is that in the beginning it was, we need weapons, we need them now. Now the conversation is, we need ammunition, and we need the ammunition to continue. There needs to be a consistent supply of ammunition, which is why they're asking for more aid. They're also asking for more sophisticated weapons as well, which we have seen the U.S. have some concerns about. But a lot of this does depend on that ammunition they want to see, and that continued ammunition. We can also say that's happening on the Russian side as well. You know, the reason why President Putin met with Kim Jong-un for old school Soviet-era weapons is because they need that ammunition to continue to flow.
Did they find the F-35?
They have not found all of the F-35. It seems that they found the
Just
wreckage
pieces
of
of
the
it.
F-35. I had a conversation with someone last night because I, like everyone else in America, I think is asking, how do you lose a $100 million jet? One of these jets costs anywhere between $70 to $120 million. It's the most sophisticated jet program in the United States. And I spoke to someone who actually is a pilot on one of these. And he says sometimes when these mishap happens, and the plane goes missing, you know, this is a stealth plane, it is hard to find, but sometimes it just crashes in marshland and the, quote, earth eats it up. That's where your $100 million is, in the earth, potentially.
It's like Yoda. You know, the plane, the starship lands in the water and sinks and loops there, and Yoda does the
I
finger
see where
thing
we're going now.
and brings the airplane
What's
up.
going on with Washington, Tom? One day it's like no suits in the Senate, and then at the same time we're losing F-35s. This is what happens when you start wearing hoodies to work, Bramo.
Oh my goodness!
Start
That's
making
the conspiracy
mistakes.
theory that you're going to come up with, is that basically if you don't dress nicely, forget it.
You lose expensive things. You just get scruffy and
and lose your F-35.
Make mistakes.
Make $100 million.
Jane Foley of Rabobank on FX up next. just experiencing TK without caffeine at the moment. Cups are flying.
Well, yeah, come on. In England, John, all there is hot brown water.
Coffee. What's wrong with hot brown water?
I don't want. Look, I had Yorkshire yesterday. I tried it, and I did P&G tips this morning at breakfast.
Breathe, Tom.
I don't get it.
Just breathe. In and out. Exhale. Inhale. You know, you've got this. It's all right.
The
Futures
coffee's
up
good here.
on the S&P. Okay, we'll get you the caffeine. It's coming.
Thank you.
On the S&P, we're a little bit higher. On the Nasdaq, +2 by 0.2%. What was that? In his veins?
Yeah, exactly. Injected.
In the bond market, 2-year, 10-year, 30-year. Your 10-year yield looks like this in the bond market at the moment. Treasury yield's higher by a single basis point to 431.66. The 2-year just won't get away from a 5 handle on a 2-year. 5.0581% on a 2-year this morning. Going into the Federal Reserve tomorrow. This is the move that stands out, though. It's in the commodity market. $95 Brent. Earlier on this morning. At the moment, 94.90 on Brent. We're positive by 0.5%. WTI crude, 92.36, up by almost 1 full percentage point. What does this change for the Federal Reserve tomorrow, if anything at all? Onto the Bank of England on Thursday and the BOJ on Friday. Under surveillance this morning, it's the Bank of France governor saying the ECB will keep rates at 4% for as long as needed. Villeroy saying this, quote, looking at the situation today, we think that is a good level. And barring surprises, we are pragmatic. We look at how inflation evolves. It's more important now to be patient, to be tenacious. Villeroy adding, we have done the right dose, but we have to take the medicine for a sufficiently long time, and we will see the deceleration of inflation. Tom, the medicine,
right?
If it's not 0% growth, I'm not sure how brutal this is going to be in Europe.
John, thanks for picking this out. This is really profound. Reuters reports that he said it's a disease. This is a guy on the edge of Bundesbank, and it really goes back to Banque de France. I was at an IMF meeting years ago, having a cigar of my choice on a roof, and there is Villeroy sitting next to me, and we talked for a while. And the answer here is this is old school European economics. This harkens back to Banque de France from another time.
It's easier to say this when people can still get jobs, when the unemployment rate in France is 7%, when you're looking at a scenario where people feel frustrated with inflation, but okay otherwise. Does that change when the medicine starts biting a little bit more? And we were talking about this with the Fed, and the bad times never came. We were all too pessimistic, as Max Kettner said, and Goldilocks forever. So how do they handle it if there is something negative?
How do they handle it with the gauze, John, of austerity? You studied it. You were our ECB reporter. There is an austere feel, as in Villeroy, in Europe that's different than the United States, and that's how you get into Summer's modern phrase of stagflation.
We're going to solve this. Sarah, would you like to bring the coffee on? We'll make this happen. Let's get you some caffeine tea.
Oh, right.
There we go.
Yes,
there we go.
Please.
There we go.
This isn't hot brown water,
Thank you,
right?
Sarah.
It's for real?
Thank you. That's for real. That's black coffee.
Is it?
All right? You enjoy yourself.
It's good.
Let me get to the next story.
I'm tang-free in London. I'm
Have a couple
not
of sips
thinking
of that.
straight.
All right. No grunting. The UAW imposing another deadline on labour talks with Detroit's big 3 automakers, saying it will expand its strikes at noon Friday if, quote, serious progress isn't made in negotiations. A union rep said no new offers had come in since it made proposals on September 14th. This is what the union wants, 36%. This is what's on offer. Stellantis 21%, GM Lisa 20%. Ford 20%.
And the argument is, at least by the UAW, that there have been no new offers from any of the auto manufacturers since they declared strike. So we don't really understand what those negotiations are if we hear that they're making progress from the auto manufacturers. We hear from the UAW they're making no progress and we have to expand the strikes. How high is that bar? Is it just coming down $4 and saying 36 or nothing? Or 4%?
Is it just about money? I don't buy it for a minute. It's about all these other structural things to reaffirm the unions back to another time and place. All that's vaporized in 48 hours.
This is about money too. Last story. Elon Musk is considering charging a monthly fee for users of X, formerly known as Twitter. Musk saying a small service fee could help fight off bot operations on the social media platform. Musk making the comments in a conversation with Israeli Prime Minister Benjamin Netanyahu at his Tesla offices just yesterday. So this was meant to be about anti-Semitism, and now it's all about how we correct some of these issues with charging everybody?
Okay, so basically this is Elon Musk saying you're concerned about the bots. The bots are the ones that are anti-Semitic. And yeah, they've increased their presence. And the way that we can get rid of bots is just to charge you more money. It's pretty rich. It's amazing how he found
Did he actually say that? These are anti-Semitic bots?
Well, he said that some of what's going out there is from bots, yes, and that you will get rid of those bots if you actually charge a fee because it is too expensive to have this type of generation of bots.
We got to stop the show, Lisa. I think it's really important. Within all the heritage of Israel and the United States, and then, you know, going back to Golda Meir and all, what is the relationship of the Prime Minister of Israel to the ADL discussion on Twitter that John Ferro just mentioned? I mean, how do you link New York City ADL into the Prime Minister of Israel meeting with the head of Twitter?
You mean that they're both Jewish? I don't know. I mean, honestly, I think that the bottom line is there has been a tracking of how much more some of the hate speech and the anti-Semitic.
I have seen it. I've
witnessed it. I've been a subject of it. But there's a question here of going forward, what the cause of this is. Is it because of an increase in bots?
Right.
Or is it in the sort of increase in the tone generally of the platform? I don't know, but it seems like a good opportunity for Elon Musk to get some more money.
And if you haven't thought about this yet, you don't need to answer, but you're a big user with a big following on X. Would you pay? Or would you leave the platform?
These are TBD
Still
questions.
TBD, yeah.
Because the question that I have is, what's the alternative? And that's what Elon Musk is pushing, and he's pushing on a string at this point because he has seen some people leave. We were talking about threads that lasted about 14 seconds, and then everybody went back to X. He changed the name, he changed the algorithms, he fired the people, and people are still on there. And so at a certain point, you have to wonder, is he just going to see how far he can push this and see what it will take to get a revolt? And if he doesn't, you're going to have to be paying fees, and if not, you know, you're not going to have access to the platform.
I'm trying to work out what the Bramo line of the sand is. $10 a month, 15,
you know,
20,
I don't
5,
want to pay. And at the same, I didn't get a blue check, and I get people ragging on me for that. But because there are all sorts of copycats and things of that nature.
I've seen them, yeah.
And
have you seen the Twitter feed Toxic Brew? It's like a Lisa thing.
That's a handle Bramo should have.
That's it.
Toxic Brew.
Toxic Brew. That works.
We're going to move on here. I'm going to do one question here.
I think that all is a toxic brew.
It's a little bit different. John and Lisa are going to jump in with really smart questions on foreign exchange. She is Jane Foley of Rabobank, and the heritage of Rabobank is commodities into foreign exchange. And Jane Foley, I want to look out 3 years and 5 years to the climate change effect. Sugar to the moon. Cocoa to the moon, a few other things, even cattle's popping up here as well. How is the Rabobank world going to change with climate change and what appear to be surging commodity prices?
It's going to be tough. Now, of course, in the short term, we don't necessarily have surging food prices because prices were high last year. There was lots of planting, but I think we can all agree that over the longer term, you have climate issues, you have issues that could create inflationary surprises in the form of food prices over the next few years. And also the supply side. I mean, look what's happened in the Panama Canal, you know, shortages of water, restrictions on shipping that can go through, impacts to the supply chain. So we know that climate change can bring us inflationary shocks. We know that it can have a detrimental impact on growth. We know that it could potentially make interest rates higher. So the environment that suggests is not particularly
John, this is critical, and that all the focus in the financial media is how to make a speculative return on euro, yen, or whatever, and there's a whole other world out there of hedging commodity transactions.
Okay, so interesting question here, Jane, for you. Climate can lead to inflationary outcomes. Can the policy changes to address climate change also lead to inflationary outcomes? Is this lose-lose on that front?
You know, I think this is a really, really interesting question because we have so many elections next year. So next year, I saw a statistic recently that said countries with a collective population of 4 billion, so that's over half the world's population, go to the polls next year. So we've got the US, we've got the EU, we've got India, we've got Russia, we've got Mexico and various other countries. Now, amongst those issues that people are going to be talking about is, of course, the impact of climate change, but also the green transition. And what we've been seeing is people, because of the cost of living, because of the energy crisis, because of you know, the impact of inflation, are losing patience with the politician, that the push towards a green transition. And we're really seeing this in Europe. Support for, say, the Germany's Green Party really gone down. Support for the far right really gone up. And this is fairly uniform because people are saying we can't afford to lose our jobs because of the green transition, because in Germany, for instance, lots of jobs in the supply chain for car manufacturers will go. And people are saying, you know, we can't afford to buy these electric cars. We cannot afford necessarily the green transition. And that's a real problem.
How do you price that into a foreign exchange call? I mean, not to be too base here, but there's really a question of who's doing the best job in counteracting some of the inflationary forces in this swirling brew of uncertainty of how you're going to deal with this. I mean, this is what we're dealing with the UAW in the U.S.
In some respects, I think the answer is quite easy, because when you are really confused, when you don't know what's going on, people tend to buy the dollar. It is, you know, the safe haven. And I think for an awful lot of these political challenges, they're going to be felt on both sides of the Atlantic. But I think it's the euro that will feel the impact of these political crises a lot more relative to the dollar, because the dollar, of course, is the currency of the global payment system, and people need dollars in times of crisis. And therefore, the dollar, in a way, gets protected, even when its own fundamentals look a little bit questionable.
And we've seen this dollar strength, and it really has upended a lot of people who thought that the ECB would do way more and that the euro would gain against the dollar, possibly even being in a better situation next year than the U.S. How much do you think the dollar has to run here if you do see this uncertainty pushing people toward the world's currency, and you also see a stronger than expected outcome in the economy there?
Yeah, well, you have it. You have this much more resilience in the U.S. economy. You have Germany in recession. You have the ECB bringing down its growth forecasts for the Eurozone last week. And in fact, they still look optimistic compared with our forecast for next year. So you have all of these issues. You've got the EU elections in June. You're going to have to see concessions made towards the far right. And when I say the far right, there is a little bit of a difference here, because many of these, what we would say far right in Europe, yes, they might be anti-immigration. Yes, they may be really nationalistic when it comes to cultural concerns, but actually they have often little left-wing tendencies in their fiscal policy. So then you get concerns about the debt outlook. You've got Italy and Spain's debt rising already through some of the parameters that the EU would prefer. Does that mean there's going to be a debt crisis? Well, no. But does it mean to say that people are going to start wondering about the debt and being concerned about that debt? Well, yes. So I think there's lots of economic factors really facing the Eurozone in the next, which are going to come to the fore in the next 12 months. And I think the euro is going to be in the back foot.
A great piece on the Italian budget coming up very soon in the Financial Times this morning. Worth a read if you can get hold of a paper or the online edition. Bramo, I think I've said it 1 million times already over the last 2 days since we've been here. Europe, what a tough spot for the Europeans on pretty much every single topic we're talking about right now, including this one.
And this, to me, is really going to be a question going forward of how you unify a place with all of these very idiosyncratic stories, including in Italy.
20 seconds. What's your euro call then? Let's go from high-minded climate analysis out 3 years. Give me a euro call out 6 months.
We need to revise it, because our forecast for now was 106, and we're nearly there. So, I haven't got around to revising it yet.
News here. Under parity?
But I would say parity next year will be being talked about.
Jane, thank you.
There you go.
Jane Foley, back to parity.
That's tradable.
Jane Foley of Rabobank on a euro, maybe going back to parity. If you are just tuning in, welcome to the programme. Equity futures right now just rolling over as Jane speaks. We're positive by 0.07%. Looking at that euro right now, 107.06.
Surging.
Parity chat, I think for the first time.
Yes.
Sweet Tom.
Yeah,
on the
she's
euro.
fired up. She's talking about some real sea changes into your. I'm going to go back to fancy talk here. The degrees of freedom that Lagarde has, next to nothing.
Do rate differentials matter, Jane, on that front for that parity call? Is that even a focus for you?
Yes, but I think when growth turns really sour, it's very difficult for a currency to pick up some steam.
OK, coming up, 8:30 Eastern Time, 45 minutes away. We'll catch up with Simon French, Chief Economist at Panmure Gordon. Need to talk to him about the central bank decisions this week. Federal Reserve tomorrow, Bank of England Thursday, Bank of Japan on Friday. In about 15 minutes' time, we'll be catching up with Alicia Levine of BNY Mellon. Look out for this one on the bond market as well. Big call from Alliance Bernstein this morning, 250 on a US 10-year, 250. Bear in mind, we're at 432 right now. They're looking for 2.5%. We'll speak to Ian Steely of JP Morgan Asset Management. He's like the Bob Michael of London. We'll have that conversation in the next hour. Up next here in London, Craig Trudell on the latest with the UAW strikes. Could they be bigger, deeper, and a whole lot longer if we don't make serious progress by Friday at noon Eastern? Live from London. Good morning.
not waiting around, and we're not messing around. So noon on Friday, September 22nd is a new deadline. Either the big three get down to business and work with us to make progress in negotiations, or more locals will be called on to stand up and go out on strike.
Very media savvy over at UAW. President Sean Fain in a video message released on social media just yesterday announcing that further strikes may come if no progress is made by Friday. The clock is ticking once again. We need to make serious progress, and apparently offers of 20% from GM, from Ford, 21% from Stellantis, insufficient for UAW and its president. That conversation just ahead. Your equity market looks like this on the S&P 500, slightly elevated, pushing higher by just 0.06%. Yields are pushing higher again by 2 basis points on a 10-year, 432.46 going into the Federal Reserve decision, TK, tomorrow afternoon.
Our special coverage tomorrow afternoon on that from London. The rumor is we came here because of Arsenal Tots. We're going to see that here this weekend, somewhat. The real reason we came to London was Craig Trudell driving all of our auto coverage here out of London, our global coverage of what they're doing in Germany and the United States, the EV revolution in China, and of course he's been distracted by his Michigan's UAW strike. What do the auto companies do? I'm fascinated. Is silence their best friend now?
I think that they are trying to follow the playbook that they're used to, right, which is keep the negotiations at the bargaining table. And we just alluded to the idea that there are some savvy communications going on the part of the union. They really are taking a different approach of really putting the terms out there, sort of communicating to their members on a day-to-day basis, really sort of whipping them up. And so there's an open question of what the heck do you do that's going to succeed to sort of, reach some sort of middle ground and be acceptable to these workers who have been sort of whipped up by their leadership.
One day in the 70s, my good friend Patrick Lynch, we were in Flint, Michigan playing music. He says, you got to see this. We went over and the horn blew, and out of Buick City came thousands of workers across Industrial Avenue to the 47 bars lined up. Jay's Bar and Grill, I believe, is the only one still left standing. That's the romance. That's what Biden wants. I don't observe that right now, do I? At all.
I don't think, I think after decades now, we've seen these companies really, shrink their presence in places like you're referring to. We will see serious investment as a result of the IRA in battery manufacturing, but it's not where we saw some of the investments in the Midwest. We're seeing factories go up in the South, factories where the UAW has, for the most part, not succeeded in organizing foreign companies, including some of these battery manufacturers that the Detroit Three are partnering with to power those EVs going forward.
Craig, the media is often guilty, including us, of making things too simple. We talk about what's on offer and we say things like they want 36%. On offer at the moment is 20%, 21%. Can we get into the details of that? It's 21% over a certain period of time. There are other issues at play as well. Where are the big lines for you and for UAW that they think this has got to happen before we even have a real conversation about making progress here?
Yeah, I think you're talking about sort of the base wages over a 4-year term, which is how these companies operate with this union. Every 4 years, a new contract agreement. I think one of the big sticking points of the negotiations is also sort of going back to the days of pensions and the companies footing the bill for pensions that workers hired from 2007 onward have not gotten as their predecessors did. We're talking about retiree benefits, which the union took on with their own trust, and that was a big concession on the part of the union that actually, by the way, has been quite successful, but the companies absolutely do not want to take those liabilities back on. So, how serious the UAW is about getting some of those things back on top of this big gulf in wages. We're talking about serious differences across a whole host of issues, and that's not even getting into organizing battery plants that these companies are going to run with foreign battery manufacturers.
What's the company's excuse, and I say this collectively for all three of them, for why they've really had record profits and haven't really passed that along at all to workers who did give some concessions during the 2009 rescuing of these auto manufacturers?
I think they will tell you that while yes, the workers have maybe not gotten the boosts that they would have liked over the last few years, that the companies absolutely need to have strong profitability to continue to reinvest. We're talking about really significant amounts of money being put into developing electric vehicles and bringing these battery powered models to market. This is a absolute overhaul of their lineups. And if they sort of allow for their labor costs, which are already higher than, say, a Tesla, to widen even further, it's going to put them at a disadvantage and actually going to be a sort of a problem for these workers going forward. They may have to continue to close facilities as they have over decades.
Let's build on that. Ford announced some layoffs in response to the beginning of some of these strikes. Are there any other additional layoffs that are planned or expected as the strikes do roll on?
I think that actually may be a sort of byproduct of if we do see the union follow through on this thread of if they don't see substantial negotiations or substantial progress by noon on Friday. The union has taken this very interesting approach of sort of targeted strikes across all three companies, and they've tried to sort of narrow the number of workers who are going on strike to sort of make their strike fund last longer. But as a result of those plants going down, you're going to see some spillover effects at other facilities, whether that's sort of on purpose on the part of these companies or a legitimate sort of spillover effect of some of these other factories going down. It sort of remains to be seen. It depends on who you ask.
My first interview at Bloomberg was Rick Wagoner on auto companies, and there was no discussion of EV. Now there's EV, but the same common feature between now and Rick Wagoner a lifetime ago is America can't build small cars. Is there a demand for the Chevy Bolt at $20,000 or $23,000? Does it sell, or is that not going to sell as well?
That's one of the real key issues here, as well as the fact that GM did bring a small, relatively affordable EV to market, actually before Tesla brought the Model 3. But it is smaller. It hasn't sold particularly well.
This, John, I think is key.
It is absolutely an issue that, to this point, we've seen these companies start to get serious, start to bring EVs to market, but very few in the sort of price range that consumers are used to buying in big volumes, the $30,000, $35,000 range. So we're seeing, Cadillacs going, for twice that, or Hummers, or Ford Mustang Mach-E's. The Ram pickup is coming from Stellantis relatively soon. These are very expensive vehicles. We're talking about $60,000, $80,000.
It's
nuts.
Insane.
It's nuts.
And that's where the push politically is coming from. In an ideal world for these manufacturers, they'd like a labor-light, high-margin business. Wouldn't everyone? They're not going to get it, are they?
They absolutely aren't. And I do think one of the things that's going to be really interesting is, if we are able to see the union sort of leverage big wins at the bargaining table with these companies and be effective in taking the message to other companies that they've tried and failed to organize. But I think that's a huge ask, right? We've seen the union sort of try and whiff on this over decades, and unless they're able to organize, more widely and more broadly in the U.S., they're absolutely taking a risk of putting their companies at a disadvantage.
I played this game with David Welch a couple of weeks ago. We were both wrong. We said something like 20% might get it done. I know you can't reduce these negotiations down to one single figure, but I'm going to. Any idea what you think is going to get this done?
I think I'll play the easy route. I know that Evercore ISI is out with a note this morning. They're saying 25 to 30%. They expect the companies to sort of settle somewhere around there. But again, I think I go back to some of those liabilities, and whether the companies are really going to continue to push back. As far as we know, they're saying no way, and the union is sticking with those at those.
Are you really working a 32-hour work week here in London?
Feels like 32 hours a day lately.
He's leading the pace.
You're setting the tone for the Detroit 3. Craig, let's do this all week. This was great. Craig Trudava of Bloomberg on the latest negotiations between UAW and the Detroit 3. Lisa, you asked the question, why didn't they pass on higher wages to their workers? Because they didn't have to, and they could get away with it.
Exactly.
And now they can't.
And to me, the big sort of discrepancy in this discussion is this isn't that big of a part of their expenses. They could do it and still survive. So what's it going to be that they have to settle on?
Their viability, their sustainability. You don't believe in the questions around that?
There's a question. I don't know.
Okay.
I'm not sure.
Okay.
Not to a certain extent. I think it might be overblown.
All right.
I've changed my tune 15 times. It'll happen again.
Might change again.
Yes,
Alicia
exactly.
Levine of BNY Mellon up next, live from London. This is Bloomberg.
US labour market's still tighter compared to what we have in Europe right now.
These central bank tightening takes time to feed into the real economy.
There's also a great deal of this notion that central banks are going to be sticking to the script.
Central banks don't actually set rates. They respond to the economy.
History would tell you that it's very, very, very hard to get disinflation without proper pain in the real economy.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. One day before a Fed meeting, we are in London at Queen Victoria Street. Good morning on Bloomberg Radio, Bloomberg Television, across America and worldwide. In this hour, we continue the theme of a sustained and even rising equity market. Alicia Levine to join us here in a moment. And John, the whole backdrop of this for Alicia Levine and others is the change. Oil, Brent crude, $95 a barrel.
And what does it change for these central banks this week, TK? Inflation potentially higher for longer. Interesting times. We've got cycle highs basically almost on a 10-year yield this morning. We've got crude at the highs of 2023 going into a central bank meeting, which arguably should head in the direction of a better tone for risk assets, which is growth forecast higher, inflation forecast a little bit lower. Tom, I think beyond 2023, you've raised this question a few times. What is in store for 2024? Call of the morning, Max Kettner, HSBC, on with us a little bit earlier today on Bloomberg TV and Radio, suggesting perhaps something that sounds like Goldilocks for a whole lot longer.
And a buoyancy here of Ed Yardeni as well coming in on that. Yardeni, of course, been on board a bull market since October. And Lisa, to me, what's absolutely amazing here, looking at OECD, global slowdown, we talk about two Americas, but there's almost two worlds. There's a world that's prospering, people here booming within Premier League. We're going to see Arsenal Tots on Sunday. You think about today, Newcastle, AC Milan. There's like a tourism boom. Joe Moek said yesterday from AXA, there's a boom going on, but there isn't.
Or you could say there are 15 worlds, or however many you want to say. I think in the middle, what you're seeing right now is things are uncomfortably expensive. People don't want to pay that ticket to go see AC Milan or the plane ticket to get there, but they're paying it anyway. And that, I think, is the key point. If you look at gasoline prices, we're talking about oil and what that does. There's still a far cry below the $5 a barrel in the U.S. going back to June of 2022. This isn't the same kind of pressure that we've seen even a year ago on the consumer.
I mean, I look at the Gilligan's Island tour you had this summer, John, 3 islands off the coast of Italy. It was a hat trick. And the answer to me, John, is do you think that's going to ebb? Is tourism actually going to ebb? I mean, that's part of this boom.
Airlines say yes. Look at the airlines, the performance on the S&P 500
domestic,
so far this
yes.
month to date. We're down about 9% on the airlines on the S&P 500.
Okay.
2 reasons. Labour costs is one. Fuel costs are going up. That's a problem. And potentially ticket prices are going down. That is a change. And I think you've got to witness that change, and this equity market is picking up on that over the last month or so.
I want to go to the strike tension. We've had some really, I mean, what we just did in the last hour with the gentleman from Michigan was brilliant here. But to me, what's wrong about the UAW analysis right now is it's all about wage. And all the other issues that Craig Trudell laid out are not being discussed. And I think they've got to be front and center.
Do you think they are basically red lines? that they're not going to
No,
drop
they're
them?
within a negotiation. They're not red lines. There's an amendment, a justice, but I don't see anybody near amendment or adjustment.
Well, and I see this in some of the discussion around the cost of employees by some of the big Detroit auto manufacturers, because if they game it out, some people estimate that their costs go up to $130 a head on average. That is not the wage. And this isn't the take-home pay. This is all of the benefits. This is the health insurance. This is the pensions. And that, I think, gets lost. It's sort of the insurance blanket is getting that much more expensive.
The benefit blanket.
And then all of a sudden,
Absolutely. I think it's
employee
really well
costs
said.
change.
Yeah.
And it's not just the take-home pay.
The overlay and the benefits was just wiped out 10 years ago, whatever, 15 years ago is not there. John, we got such a good guest. Let's get to the data here. Look at Euro popping up a little bit, stronger Euro.
Yeah, just reclaiming 107. Jane Foley of Rabobank on with us about 15 minutes ago, talking up the prospect of parity on the Euro into next year, given the difficulties for the Europeans relative to the upside surprise we've seen from America so far this year. Whether that spills into next year, I've got no idea. 432.86 on a 10-year yield high by 3 basis points. Talked lots about $95 Brent, 92 on WTI, 92.68. Crude high by 1.28%. Tom, and futures, I think we call it unchanged on the S&P, just about unchanged this morning.
Unchanged, we're focused on economics, finance, investment, and international relations, but we digress. We said we got to get somebody on that really can get to the pulse of continental emotion. And you're going to see that today with Newcastle playing AC Milan in Milan. And we needed to go to someone who understands the roar of San Siro like John Ferro. Ferro insisted that Alicia Levine join as head of investment strategy and equity advisory solutions. What is it like, Alicia Levine, the cultural event of Milan and that stadium?
It's alive, and it's alive for 2 hours, and they sing for 2 hours straight. It's fabulous. It's just fabulous.
Would you like to cut in, John, here with the song?
I'd like us to take away those pictures of Inter versus AC Milan, because that did not go well.
That did not go. John, why don't you pick it up here?
I can remember my first game. I watched Juventus versus AC Milan, and I remember walking up to the stadium, and the away fans get there early, so there aren't, you know, clashes, fights, etc. And I just remember the sound bleeding out at the top of the stadium, and I was standing with my dad, and we get closer and closer to this stadium, and it gets louder and louder and louder. And you go inside, and the acoustics in that stadium, it's so unique. All the noise just rebounding off every single corner. And to Alicia's point, the ultras, the fans that sit in the Curva Sud, they do not stop. An hour before the game, through the whole game, and you hear them coming out of the stadium. It's like something you'll never see, Tom. My cousin Fabio is in that group of supporters that sits behind the goal, and I'm too soft to sit with them, so I sit
across America. This is religion here at Team Surveillance. John Ferro glued tonight to the screen here in London. Alicia, let's stagger to the equity markets as we can right now. We've got some bullish voices today. Can you be a bull? Are you enthusiastic about the Standard & Poor's 500?
So I'm measuredly enthusiastic, meaning we have to get through the next month or so, because the kinds of risks you've been talking about, which is the UAW strike, yields at a cycle high, definitely present sort of wild cards to what is a reasonably good-looking fundamental picture. And of course, these are the things that could really derail the picture. I think that the S&P is typically soft this time of year. Why September and October, we can discuss at another time, but it is soft. And yet, we have not seen tremors really in the equity market of the kind we've seen in past years, given the risks that we're seeing. Suggests to me that we're probably going to muddle through, consolidate here. I do think there's some risk to 4,200 here, simply because that would be a reasonable way to absorb some of the yield increase that we've seen, and then move forward from there. I mean, in the end, we're going to finish this quarter at close to 3%. Very hard to get a recession when your GDP on a real level is close to 3%. So even if we slow in the fourth quarter, the year ends strong. You know, we would assume still 40% chance of recession, because in the end, higher for longer means there's going to be further tightening here in the real economy.
Alicia, just want to get your thoughts on 2024. Max Kettner of HSBC was on the programme with us a little bit earlier, and he said we need to focus more on what could go right, because expectations for 2024 are so low. Do you agree with that, or would you take the other side?
So I would agree with that. And we actually did the same when we do our mid-year review, and that was released at the end of June, because we decided that the focus on the left tail risk had really not been fair to what's going on in the real economy. And in the end, the American consumer has really held up this economy here in ways that I don't think any of us expected at the beginning of the year. And so it's very important to really look at what the right tail risk can be. In the end, if we have no recession this year, the earnings picture can be closer to 225 by the end of the year, and then you grow from there for 2004. If you have between $240 and $250 per share for the S&P in 2024, markets can get over 5,000 to 5,200, which is what we have in print. And that really sets you up for a nice rebound even further from that. A slowdown is not a recession. In the end, even though vastly every time the Fed has tightened like this, we've had a recession, what's different this time is the antecedent. And the antecedent is 12 years of near zero rates. And as we know, that has cushioned households and cushioned corporates coming into this tightening cycle.
Everyone was saying that this rally had to broaden out to be sustainable, and it sort of did for a second and then backed away, and tech kept leading. Is that going to be the dynamic going forward? Because that is truly the growth area. And some of these other areas, like airlines, like auto manufacturers, face some of these headwinds that we've been talking about.
Right. So, look, we do need to see the broadening out here. Look, in the end, 97% of the energy names in the energy sector are above the 200-day moving average. Only 62% in the tech sector are above the 200-day moving average. So it is broadening out in a way. I'd say this. I think that tech has to participate. It cannot lag. It cannot lag. If tech lags, it's going to be very hard to get the averages up. Obviously, it's simple math. 40% of the average is communication services and tech. So we do think that the yields here could put a ceiling on some of the multiple expansion that we've seen in the tech sector. But if earnings are moving higher overall, that will support the market.
How bullish are you, just on a scale of full bull to bear? Where are you kind of sitting at this moment?
As I like to say, we're paid to worry. And so I would call myself between a 6 and a 7. I think the fundamentals are very good in the real economy, understanding that there's some softness in some parts of the consumer sector, and yes, some balking at paying some of those fees. Airline fares is a great example. But I do think overall the cushion that households have in fixed rate debt, as well as the corporate sector, I think that's good. I worry more about a yield-induced issue somewhere, whether it's the corporate real estate market or elsewhere. I think that's the place we have to look to where this rosy story may stumble a little bit. So I see it less on the fundamental side and more sort of what's going on in the sectors that are really very sensitive to yield still.
Alicia, thank you. Just wonderful to catch up with you. Alicia Levine there of BNY Mellon Wealth Management, and thank you for sharing your vacation with us, which sounds absolutely wonderful, Tom. 2 AC Milan games, a trip to Monza, all in the space of a couple of weeks. Does it get any better than that?
Just
awesome.
It's like,
Lisa
and I are working all summer, and we're in New York, and the closest we got to an
took off half of August.
It's true.
The closest we got was an island called Manhattan, and
it's a great island. Lots of people go on vacation there.
You're doing a George Clooney imitation.
Where else did you go, Bramo? Alaska, Costa Rica. Yeah. Right, it's you that didn't go anywhere.
Yeah.
If you're just tuning in, welcome to the programme. The S&P positive here by 0.07%. Yields are a little higher by 3 basis points, 432.86 on a 10-year. Simon French of Panmure Gordon joining us in about 15 minutes' time. We'll talk to him about the Bank of England decision on Thursday. We'll talk to Bramo about Bramo's new scale, which is full bear at the one end and full bull at the other. Is that new?
Yeah, I feel like we should actually have one. I feel like
we should have a scale, sure.
Have to place themselves
that they've got
on
to
that
identify
scale.
with when they come on the show.
Exactly.
Yeah,
when they come on the show, they have to identify where on the scale they are and then justify it.
It's that kind of market where people are making some real conviction calls here to 2024. John, you mentioned outlooks are coming out, and that's what we're going to get to. Off the camera, Jane Foley was really quite good, John, about, we talk about the scale, the bet, the politics going on right now. The delusion we have in London of the prosperity of London versus the rest of the United Kingdom. And among others, Mark Carney has mentioned this to me before as well. And it's not like Paris and the rest of France, but there's some real stark differences in the
Every
United
country's
Kingdom.
got a major city.
Yeah.
And in the UK, if you take London out of the equation, there are some difficulties.
Yeah.
Without a doubt, without a doubt. Coming up on the bond market, Ian Steely of JP Morgan Asset Management. What did we call him? London's Bob Michael. We'll see if Ian likes that. Up next on the programme, live from London, this is Bloomberg.
Central banks don't actually set rates. They respond to the economy. The Fed, they are finally caught up with the curve. Yeah. That doesn't mean that they're at the end, but they actually have a chance to pause. And so it's a toss-up there. But the Bank of Japan is actually potentially changing course.
Marvin Barth, founder of Thematic Markets. Can I just say how quick Bob Michael is? So I refer to Ian Steely as London's Bob Michael, and the real Bob Michael appears literally around the corner. Ian, does Bob let you go out anywhere without him? You know, it's
like the shadow of Bob Michael.
Seriously,
compliance issue.
Is that what that is? Ian Steely's going to join us in just a moment. Really important statement has just come through from the UAW president, Sean Fain. I want to share it with you. The former president, Donald Trump, would very much like the support of UAW. I can tell you, based on this statement, he's not getting that. Every fibre of our union is being poured into fighting the billionaire class and an economy that enriches people like Donald Trump at the expense of workers. We can't keep electing billionaires and millionaires that don't have any understanding what it is like to live paycheck to paycheck and struggle to get by, and expecting, Tom, them to solve the problems of the working class.
And this is the charm of the President of the United States. You can argue about it all you want about, you know, money that's come in for Joe Biden late in his life, but his entire tenor here is, I was in Scranton, I've been at those kitchen tables, and all the other fancy people in Washington haven't.
That's the pitch. Here's the problem. Billionaires and millionaires. I would take that statement as not just pushing back against the former president, but perhaps the whole political class in Washington, D.C.
Yeah.
Many of which senators in that Senate currently are millionaires, and the president also is one of them as well.
And the calculation here, and I don't have any wisdom on this, is public sector and massively diminished private sector unionization. These are dialogues of another time and place, and the numbers aren't there like they used to be.
Well, my question is, we've seen Republicans try to court some of the Rust Belt and try to get and pick up some of the discontent that we've seen. And they have. And Donald Trump was planning to go there on September 27th to Michigan to stand in solidarity with the UAW in rival programming to the next Republican debate. Will he still go if this is the line?
What's he going to do? Is former President Trump going to say, I believe in a defined benefit program? I mean, those are the issues that we heard from Craig Crudell that we aren't talking about now, besides pure wage, and are they going to make more than an Amazon warehouse worker?
I can't guess what Sean Fain is going to do, the UAW president, but if we were to base our assumptions on that statement alone, that is not a UAW president that wants to go out there and campaign with the former president, Donald Trump. And if the former president wants the support of UAW, based on what we just heard there,
I believe these executives, including Mari Barra talking to David Weston, these are millionaires and billionaires. Well, maybe they're not billionaires. I don't want to stretch it too far. Maybe Bill Ford is. But the bottom line to your point on millionaires is that's a statement against the executives as well.
It's the political class.
Yeah.
It's on the political class who have spent a life in politics. And I'm not talking about the former president here, obviously. But those who have spent a life in politics and have managed to amass amazing fortunes over that period. Okay? And the failure of them to protect the people that he's meant to represent that work for these institutions in Detroit.
In our Fed coverage tomorrow, this will be addressed. I can't imagine it has got to come up in the press conference. Michael McKee, of course, in attendance there, as always. Right now, this is always timely. Is Ian Steely with us? He's international CIO within global fixed income, currency, and commodities at JP Morgan Asset Management. He has to share a desk with Bob Michael when he comes into London as well. John, why don't you bring in Mr. Steely here, because you are.
I'm not sure Ian wants to talk to me anymore, but I'll try.
You know, more. I can see Bob over his right shoulder. Hi, Bob.
Ian Steely at JP Morgan Asset Management joins us now. Ian, fantastic to have you with us on the show. Let's just get straight into the bond market. We've got this amazing call from AllianceBernstein this morning, 250 on a 10-year. You and the team are pretty constructive on the long bond, let's say the 10-year. How are you thinking about what this offers currently at 433 on a 10-year in America?
I think you've got to say it's a pretty good valuation. You know, for those people who wanted, you know, to buy back into the bond market earlier this year, We had that rally. We've now sold off again. We're back at the highs of the cycle. When I look at what's happening on both the inflation picture, we are trending down in core inflation over the last 3 months. The jobs picture is trending down as well. We know we've got student loan paybacks. We know we've got tax in California. We know we're coming towards the end of those excess savings. It feels like at 4:30, that's a pretty good environment to be buying back into the bond market.
Bramah wants to get in here with some intelligent bond questions. I'll ask you a dumb question. Are you clipping the coupon, or can you really invest for total return in the next 12 months?
I think it's a total return. I think, well, firstly, you've got the coupon. 4.3%. That's some of the nicest yield that we've seen in 15 or so years. And then you have got an environment where if we do start to slow, the Fed does start to feel that the growth slowing and they need to ease policy, then you're going to get some pretty decent capital returns. And if you look at previous hiking cycles, once the Fed pauses, the bond market does very well, and it does much better than cash.
We were talking about the AllianceBernstein call of 2.5% on the 10-year by the end of next year. And John asked the good question of why, right? Is this because of a huge drop-off in growth or just a moderation in inflation? Is that sort of what's underpinning a Fed that reverts back down to something lower? What's your call? What's underpinning your bull thesis here on bonds?
I think it's a combination of two, both of those. So we are seeing that moderation in inflation. We are seeing inflation coming back down towards where the Fed would like it to be. And then we do see the growth weakness. And I think the Federal Reserve, and we'll hear from Powell tomorrow, I do think they believe that they are restrictive, and that as the lagged impact of policy, and I think, a lot of people saying, how lagged are these impacts? Well, I think actually, a lot of people invested, or a lot of people borrowed at very low levels. They've locked in those low yields, but they will start to come through. And I think that the lagged impacts are going to take a hit next year. So you are going to see that slowdown in growth.
So does this counteract this idea of Goldilocks forever that we were hearing from Max Kettner, or actually by John, but that he reiterated?
Max Kettner.
Max Kettner, that he said. Or is this basically pushing back against that and saying this is something a little bit deeper than that and maybe a little bit more pernicious?
So we're obviously in this Goldilocks scenario at the moment. The market's basically picking up on the fact growth's coming down. We're slowing from an inflation standpoint, but we're not rolling over just yet. But I think we can't have Goldilocks forever. We are going to start to see biting within the growth standpoint. And I think what's happened this year is we've had a lot of support. We've had a lot of support on the fiscal side. We've still had all those payments, all those checks, all that monetary policy, all that fiscal policy that came through in the pandemic, wash its way through the system. I think we're now coming towards the end of that. This period, this Goldilocks, this slowdown period is taking a little bit longer than we thought. But when you look at historical periods, again, there's very few instances, the mid-90s probably been the only one, where we've had that slowdown without dipping into a recession. But you always feel at this point that it is the Goldilocks. It is the best environment until we actually start to dip over.
Bramah wants to geek out, so we can, with a May 2050 Treasury bond. We did this great story in the last 24 hours about how it's trading at sub 50, the price damage done to that long bond. And within the story, they talk about positive convexity. Can you just talk to us about that as a concept and the opportunities that lie in, say, the longer issued debt, the longer maturity debt after all this price destruction over the last couple of years?
So let me start by also saying let's take a step and look at the UK gilt market and look at some of the long-dated bonds there that are trading in the 20s and the 30s. So even more so. So
wow.
for US listeners there, so you're doing great. Look, so what you do is that bond, in the end, is going to pull its way back towards par, because ultimately you get par back at the end of the life of that bond. So you get the capital appreciation on that, although you are clipping a slightly lower coupon than you would like, but you'll get those capital gains come through as the bond moves back towards par.
Can you bring this to my Austrian bond, which has been a disaster, my 97-year piece? Do I have positive convexity in my 97-year tanked Austrian piece?
It will have a similar situation. It's just going to take a little bit longer to get there.
50 years. Ian, that's just great.
Yeah, this is great. It's good to see you. Ian Steely of JP Morgan Asset Management. TK, some real price destruction, and you've been on top of that, Tom, over the last couple of years.
The price destruction's there, and this is to the other side of the debate of AllianceBernstein. If you look at the Bloomberg indexes, folks, they're very valuable. We're not on support. I'm not going to give it a lot of angst, John, but the fact of the matter is, you get higher yields, you get some real technical breakdown.
We've got higher yields this morning, up 3 basis points, a 10-year 433.46. Up next, Simon French of Panmure Gordon. Housing data due in about 20 seconds' time. We'll get housing starts, building permits. Mike McKee's going to break that down for you. Going into it, equity futures on the S&P just a little bit higher, up by almost 0.1% on the S&P 500. The Nasdaq totally unchanged going into the Federal Reserve tomorrow afternoon. Your bond market is set up as follows: 2-year, 10-year, 30-year. The 10-year yields a little bit higher through much of this morning, up by 3 basis points. The 10-year 433.46. With that economic data is Mike McKee. Morning, Mike.
Good morning, guys. It looks like another good report for housing starts, down 11.3%. I'm being sarcastic there. Now, how much of that is weather and how much of that is a drop-off in home builders' outlooks towards the industry is going to be an interesting question to ask, because we did see the National Association of Home Builders report lower traffic among customers and a decline in their optimism index earlier this week. Building permits were up 6.9%. So perhaps it was a weather-related thing. Perhaps it was just a slump, because it looks like they still are interested in getting some kind of business out there. Let me see the press release. You guys, I don't know if there's any reaction in the markets to this, given the Fed tomorrow, but if you've got something, let me know, and I'll find out if there's anything more interesting in this number.
Yeah, Mike, never usually get big moves off the back of this kind of data, but it's interesting regardless. Michael McKee, thank you, sir. Yields up just a little bit by 3 basis points on a 10-year, where we were, 433.86 on a 2-year yield, higher by a single basis point. Again, basically where we were at about 5.07%. Just to check in on foreign exchange, we'll finish on the euro here. The euro, a little bit early this morning, getting back through 107. We were in and around 106 for much of the last couple of weeks. 107.12, positive here by 0.2%. The last data point, I guess, setting us up ahead tomorrow, Tom, for the Federal Reserve tomorrow afternoon, with all the forecasts we're expecting from Chairman Powell and the committee.
The Fed tomorrow afternoon, a lot of good coverage on that. Of course, we will be covering the meetings here from our studios in London. And just as important, we follow on to other central bank discussions. Simon French, Chief Economist Pamela Gordon, has been just wonderful with his experience in the British government of framing out a governor of the Bank of England who said, well, we're not going to declare victory. And boy, has the news come down the pipeline since Bailey said that. What are the ramifications of higher interest rates in the United Kingdom?
Well, we think there's about 60% of the 515 basis points delivered by the Bank of England still to crystallise, principally for the household sector in the UK. And that lagged effect is an elongated lag from previous economic cycles, where the structure of the UK housing market, secured debt market, was very different. And that is why I think Andrew Bailey has a really difficult task on his hands later in the week, because all the indicators I'm seeing is with that long lead-in time and the majority of the impulse still to come, we're seeing quite a rapid slowdown in payroll wage inflation. We're seeing a slowdown in core inflation. With the 18-month, 2-year lag, whatever frame, we think it'll peak around Q4 2024 in terms of the tightening of financial conditions for households. He knows that. He sees the inflation picture coming down, and yet he's allowed markets to guide the policy expectations rather than lead them.
At Durham, you were steeped in the economic history of all this. How close is the United Kingdom Bailey analog to the United States Powell analog? How separate are those discussions?
I think they're really separate, actually. And I think the last time I was on the show, I talked about the biggest decoupling of the policy environment in Europe from the United States. But it's not just the pathway, it's also the management of market expectations here. We've had some speeches from the MPC, the Monetary Policy Committee, from the Chief Economist Hugh Pill in South Africa about 10 days ago, talking about a potential plateau, but the market basically didn't believe that and sees the likelihood of a 25 basis point of about 80% as I left my terminal earlier. That is not where the Bank of England wants to be if it's going to carve out a narrative based on the latest data points, which show quite a rapid sharpening of economic momentum and also price-setting behaviour in the UK.
I won't allow the point you're making to get lost. This is so important. I landed here over the weekend. I read the recent communication from the Bank of England. Then I looked at all the economists' expectations, and they were saying hike, and the Bank of England was basically saying we're not hiking, and I couldn't make sense of it. Are you saying that Threadneedle Street is a massive credibility problem at the moment, and basically the markets are in charge?
Yes, I am. I think they're getting the wrong sort of criticism. They're getting criticism for being too slow in terms of takeoff on the policy path, but actually they moved earlier than the Fed. They moved earlier than the ECB. Actually, it has been the communications through this cycle. Part of it's been quite cumbersome in terms of, getting into the wage bargaining negotiation, the profit margin negotiation with corporates, with the household sector. That's not the role, as I see it, of central banks. Central banks, if you see a dislocation between the way the market is pricing your optimal path for monetary policy for financial conditions, you intervene. And it can be quite close to a policy meeting, which is to Tom's question about the decoupling between the Bailey-led Bank of England and the Fed, the Powell-led Fed. They've been reactive, not proactive in terms of managing expectations for this meeting. And it's been a regular pattern, unfortunately, over the last 18 months.
So even though you don't think they should, do you think they will hike on Thursday?
It's difficult, isn't it? I'm very clear that my reading of the data, and look, I don't want to sit here and pretend that I have a better reading than the 9 members of the Monetary Policy Committee, but I do think that the market has allowed itself to get expectations of a rate hike that I think the Monetary Policy Committee probably look at the latest and the most timely indicator of core inflation and wages, which they set out to their August Monetary Policy Report with their key data points. Those have slowed in July. Those have slowed in August. That's the new data that's come into the marketplace. Taking account of that, there's only 6 weeks till the next policy meeting when they'll have a new set of economic forecasts. You can pause that one out. You can say we're aligning ourselves with the potential pause in the US and in the Eurozone and not be an outlier. You don't want to be a monetary policy outlier in the UK.
There is a question, though, about a reacceleration in inflation, especially on the heels of oil prices that have been climbing. We just got news from Canada that inflation came in at 4% year over year in August versus a 3.8% estimate. We have seen this again and again. What's to say that there isn't something underpinning those inflation figures that will reaccelerate, that does warrant what we heard from Jennifer McEwen, which was a 50 basis point rate hike at Thursday's meeting?
You speak to exactly why an extra 6 weeks is most valuable, because those oil price assumptions, we're seeing similar turbulence in soft commodity markets, a leading indicator of food price inflation. The Bank of England redoes its forecasts in the first week of November. In fact, it does it in late October. It will have at its disposal for the MPC the type of impulse that will come through from those higher prices in terms of headline inflation and the potential second-order effects in terms of core price setting. Why would you not give yourself the optionality of an extra 6 weeks to appraise those leading indicators, but also model the impact of those core inputs?
If what you said earlier, though, is true, that this is a central bank that has lost credibility and lost the plot, then wouldn't you see a pound that just weakens dramatically if they were to do that, if they were to pause, even in the face of people saying you need to hike and you need to hike more aggressively?
My reading of the way people are trading sterling, it's not based on a spread of central bank policy rates. It's on a spread of credibility. If you do a credible pause, you enhance your credibility. I'd expect sterling to strengthen against its major pairs, against that backdrop. If you deliver a message that says, we understand how this economy is evolving, we're in front of the data, we're guiding the market, rather than being reactive to each bit of pricing that they're seeing.
We got a bunch of thugs asking questions of Jerome Powell here tomorrow. What question would you ask Jerome Powell?
Well, I'd be fascinated to see what the FOMC come out in terms of long-term R-star. I think for me that's the key data point in the summary of economic projections we get. Do they believe it's still in that 2.5% to 3.5% range, given all the way out to 2 years we're seeing potential Fed funds rate north of 5%? Have we reached a situation where actually the FOMC have got to throw in the towel in terms of long-term R-star and the repricing that would have across equity markets, fixed income markets? That's
would move the markets.
Do you think they're ready to do that?
Well, ask the question. You might be surprised by their propensity to give you an answer.
Just didn't seem want to go there in Jackson Hole.
Oh no!
In the speech,
it's the skill of the Bloomberg team. So
yeah,
tease that out.
Mike McKee's better at this than I am. Williams will go there. The New York Fed president. What's the guidance you would take from a man like that on where this might be going?
Influence. So the degree with which a debate. You're right. Almost certainly, Jay Powell is far too good an operator to even get tempted into that debate. The degree to which other members of the FOMC can start to frame that debate and say, actually, part of And we've seen financial conditions loosen quite appreciably in the US economy. Part of keeping those elevated actually is to have that debate in public, such that markets can understand what that pathway is for long-term R-star in the US economy. Because at the moment, the summary of economic projections do not tell you that story.
Liz Ann Saunders was brilliant on this yesterday, John, looking at the Bloomberg Financial Conditions Index. It's screaming accommodation right now.
This speaks to a phrase that Lisa used, reacceleration. And I think we're talking about the UK at the time. In that conversation, in that part of this conversation, the prospect of reacceleration in the US, something that we've heard a few times from various guests, is that current disinflationary trend is transitory. Would you go that far?
Oh, the dangers of using that word. Look, there is no doubt. I mean, if we're talking in the context of the US economy, the oil price is more significant. Actually, domestically in the UK, the gas price is more significant, which hasn't taken place or hasn't moved up in the same way. Look, central banks have carved out in the last 6 to 9 months a focus on core inflation. And therefore, are we now going to sort of pivot back to focusing on headline inflation? And given the impulse seems to be through the oil and commodity markets, that's going to be the first order impact in pushing headline inflation. It means feels like you're moving the target every single time the data doesn't conform to your narrative. We're talking about credibility, talking about the credibility of central banks. You've got to be consistent through the cycle, not just to fit your narrative.
If I could put you in a press conference right now, it wouldn't be the Feds, it would be the next Bank of England decision in a couple of months' time. That decision, is it November? The November one with the news conference. That is going to be... What are those forecasts going to look like for inflation, do you think?
Well, in terms of... This is why it's the opportunity to talk about how the relevance of gas, wholesale gas in the UK economy being the more relevant one. Actually, I suspect the expectations for inflation will actually be lower for 2024 than we saw last week from the ECB. Remember what spooked the markets in terms of a north of 3% inflation print in the Eurozone in 2024? We got it from the OECD today, 2.9% in the UK. I think the bank will back into that forecast, a sub 3% forecast for CPI, because of the relevance of gas, which on the 2-year curve is about 80% lower than it was in the summer of 2022 when UK macro became the front page story. We had Yellen talking about it, Larry Summers talking about it because of the mini budget. But it was not just the mini budget, it was the dislocation of gas prices and how impact that is on real incomes in the UK.
You're talking natural gas.
Natural gas.
See, in America, we would say petrol. I mean, petrol, we confuse that. We say
gasoline and
I allow you to translate my ropey narrative, Tom.
I said, keep up with you.
We're in London.
I did the
I'm going to start singing Mary Poppins to you.
The liter of gas 2 hours ago, we were talking about where does it hurt in the United Kingdom, like where will it actually affect Bank of England. There it is, John, $7.57 per gallon, $2 per litre.
It's brutal. I also can't believe
Did I spell litre correctly there?
It's the 1 year anniversary of the mini budget, isn't it? It's on Saturday.
It is.
Simon, thank you. Always a pleasure. Always learn something. Simon French there of Panmure Gordon. If you are just tuning in, welcome to the programme. Your equity market on the S&P 500 is slightly negative. We're down here by 0.06%. Elsewhere in the bond market, yields just creeping higher, just a little bit more, up by another 4 basis points, Lisa. 3.3466 on a 10-year in the FX market. We're not doing much at all. 107 flat on the euro against the dollar, and crude just short of 93 on WTI and back through 95 on Brent.
Wow. So here's my question, and I was listening to Simon there about oil and how much the Fed should care about it. The problem is it goes into goods pricing, and goods pricing is what people see potentially reaccelerating in the U.S. And the key here is if people pay the higher prices, then it is inflationary. If there still is enough demand in the economy for people to be able to absorb that type of price inflation, that's really the concern. So you can't strip it out entirely. It can't be too cute about just saying this isn't going to go into the picture.
Away from the City of London, away from Wall Street, it confuses people. In fact, I think it angers them when we all start stripping out the things they have to pay for, like energy. And if there's one thing that shapes inflation expectations in America, the one thing that I've learned living there for the best part of the decade, it's the price of gasoline.
Well, yeah, certainly if you're responding to the University of Michigan Sentiment Survey.
Precisely. And we're sitting here saying, yeah, you can strip that out.
Right.
You can strip this out.
Exactly.
And things are improving. Coming up, Peter Trubowitz of the London School of Economics. Equity futures just a little bit softer. Your opening bell about 45 minutes away. Live from London. Good morning to you all.
one of the things with China is they often make mistakes, but they typically don't continue making them. And so it's, in a way, a matter of time before they make the appropriate adjustments and start growing again. But in the short term, I think it's going to be somewhat difficult.
It's been far more difficult than we thought it would be. That was Stephen Schwarzman, the Blackstone chairman, CEO and co-founder, speaking a little bit earlier on Bloomberg Brief with Danny Berger. Danny Berger, Manus Cranny, every single day, weekdays, Monday to Friday, 5 a.m. Eastern Time on The Brief, newly launched. Look forward to that programme every single morning. Equity futures on the S&P 500, a little bit softer here, negative by 0.1%, just pulling back a touch here as yields drift higher again, up by almost 5 basis points now on a 10-year, 434.86. In the last day or so, last couple of sessions, Tom, we've come really, really close to new cycle highs on a 10-year yield. We're breathing some life into that move again off the back of this move in crude. 95.20 on Brent, 92.80 on WTI.
To correlate this, I would take the move on Brent crude, 95.21, right up near the intraday high, 95.28, and say, given 3 central bank meetings, do we get the U.S. 10-year inflation-adjusted yield nicely through 2%? I don't think that's modeled in the market. That's signal of higher real rates.
The conversation I was hearing this morning off the London desk, Lisa, was whether we should be breathing some more life into this Treasury short off the back of this move in commodities. And that maybe there's this feeling that this $90 price doesn't last that long and you can kind of look through it into next year.
Which is a reason why the disruption from higher oil prices isn't really getting framed out in markets in any kind of catastrophic way. Right now, it's sort of something to watch rather than the front and the focus.
We'll just, have to see. I think the data flow here, there's a deceptive stasis to the market right now. How long have we been at 4,500? How long has the VIX been 13.XX? And my operative word is deceptive, and that boom, something's going to happen at some point.
There's nothing quiet about this rally.
Yeah, exactly.
It's something like a 35, 37%.
Well, look, there it goes. It's
bursting
right now through.
95.50, basically.
Yeah. Well, there we are. Lisa, what do you got? You got some...
I just wanted to look at a couple of names. Stellantis in particular. We've been talking about the auto strikes. Well, Stellantis in this case. Those shares are popping. They're up almost 2%. And this comes after the North America Chief Operating Officer, Mark Stewart, was speaking in an interview on television this morning and saying that Stellantis has the inventory to offset the strike impact. So that's some of the communication there.
And then with the odd thing to say, isn't it? Sorry to jump in.
Yes,
isn't that a strange thing to tell the UAW? That we can cope with a harsher strike, bring it on?
It's either strange if you think that it would hurt them, or it's basically a bargaining chip to say your fund's going to run out before we can really feel the hurt.
Did they have the inventory of Jeep Wagoneers and stuff because they weren't selling?
Well,
or the
that's a
Broncos
whole
are
other
selling
question.
like hotcakes.
And we can explore that tomorrow. I do just want to bring you 2 other names that I thought was interesting.
No, we want to talk Stellantis. No, we don't. Don't worry.
But here's my issue. We've heard so many personnel stories of mysterious exits recently, haven't we? Of like different CEOs, et cetera. The latest, Block shares are down by more than 2%. After the company said that the head of its Square Payments unit was stepping down. It was a surprise. Jack Dorsey is taking over.
So Dorsey's back?
Dorsey's back
with
the beard and some very interesting Instagram posts.
Fire dancing?
That was something else. Okay.
Yes, is that what you were talking about, right?
That's what I was talking about.
I saw that.
And then CBOE, another one with a personnel issue. Edward Tilley has resigned following an investigation that determined that he, the CEO, didn't disclose personal relationships with colleagues. Another one of these. Exactly. That's what I'm saying. Yeah. This is not the first time. So
Who's the one recently? BP.
It's in the
yes,
air.
BP.
It's BP.
And that
it's
was a real
in the
question.
Air. I mean, it's every morning you pick up the paper, and there's more of this stuff. People are handling it well in terms of PR and that, but it doesn't go away, does it?
And we always want to know what's the story or the personal relationships. Then we never find out. I always look.
We're going to continue forward now.
With the gossip pages.
Of course, we all do. Come on.
SIBO.
We'll move on.
We're going to move on. We're going to continue forward now. Always a high point in London to speak to someone from the faculty of the London School of Economics and Political Science. And this is Peter Trubowitz, an American voice in London here, professor of international relations, of course, working with the August Chatham House as well. I've got one insight I want to go to, and this goes back to your work at Texas in the fabulous LBJ School. You and I are the only two of a certain vintage in London that actually remember stunning on a Sunday night when the President of the United States spoke to the American people and said, I'm not running again. It was Vietnam, it was a crushed LBJ, and there he was walking away. What are we going to see from Joe Biden? Given all the flurry that's out there right now, you are truly a student of this. How does a president exit lightly if he's going to?
Well, I'm not sure we're going to see a bombshell like the LBJ bombshell. I mean, if you go back, I mean, that's an interesting comparison. I think LBJ not only lost the support of the American people over the war, but critically, he lost the support of the party leadership inside the Democratic Party. And I think right now what you see in Biden's case is while support is down in the polls among Democrats as clearly among Republicans, I don't see any movement among the Democratic leadership. That's what we would have to see first. We would have to see some cracking in that support. He's always got a way out. He can always say that he saw himself as a steward, right? But the concern is who would be his replacement. And there's a lot of concern inside the party that it would be Kamala Harris. I mean, so this is the issue.
I was reading Rick Atkinson's World War II, and I was flat. John, I got this so wrong. I looked up Winston Churchill's age in 1944, and he was a fossil. He was gerontocracy. How in God's name did the United States get to the fossil administration and legislative branch we have now? How did we get to gerontocracy?
Because I think we've had too many presidents who have not been basically curating the next generation. I mean, you know, it's true of Obama, it was true of George W. Bush, certainly true of Donald Trump. That's the job. The president needs to bring on the next generation. So you could say that Biden has at least made a move in that direction by virtue of who he picked.
Starmer and Sunak are a breath of fresh air. I mean, you know,
I won't offer my opinion on their personalities,
no, I don't mean
Tom,
but they're younger.
Certainly younger.
But they're younger.
Parliament's a whole lot younger than the Senate as well. I'll go through the theory, Peter. The theory goes something like this, that the president's not going to make a run for 2024. What he's going to do is draw this out to try and make the primary short. The logic being that if you have a long primary, it shifts the candidates towards the extreme, and he doesn't want the party to go too far to the left. Yeah. So he's going to make this call late. What would you say back to that?
I think it's possible, but the problem there is that you don't really give someone enough time to get traction. Who's the heavyweight? Who's the heavyweight in the shadows? From California? He's going to pick up red states?
That's the talk.
Well, I know that's the talk, and so you're asking me, and I'm telling you, I don't know. I mean, I think it has some credibility. I mean, I would think we'd go to Michigan if we're going to go for a governor.
Oh, you have got someone in mind then?
Well, I mean, you can play this out, but if you're not giving somebody enough time to generate financial support, build up a head of steam, you know, I mean, it is true, if you went with a younger candidate matching up against, let's say, Donald Trump, there would be some real daylight there.
What are you expecting to hear from Biden today? What are you listening for?
In that speech, I think that speech is going to be principally geared towards countries in the global south. I mean, some of it will be about Ukraine, and there will be a pitch there. But he's got a great opening here. Putin's not there. Xi Jinping is not there. This is the time to double down on appealing to the global south. There's been a lot of movement in that direction, and he's doing stuff on the sidelines there. I mean, this afternoon, I think he'll be meeting with 5 members from Central Asia, from the stands. And that's the purpose of that, is to open, expand U.S. influence, go back into Central Asia, and build up a new flank. This one on the west. The other, he just recently tightened relations with India on the south, and of course brokered the rapprochement between Japan and South Korea on the east. So I see these as, so I think that's part of what's going on, at least on the sidelines. But I think the main focus, in addition to Ukraine, will be what the United States is doing for developing nations.
Interesting. Peter, thank you.
Good to be with you.
I would love a longer conversation at some point on this EV transition and the international relations of all of that, because it's fascinating at the moment. Peter Truvitz there of the London School of Economics. Thank you, sir. Coming up on Bloomberg a little bit later today, 11:45 Eastern Time,
Jens Stoltenberg, the NATO Secretary General, live from the United Nations, alongside Bloomberg's Anne-Marie. That is one you don't want to miss. Coming up tomorrow, our Fed coverage on the Fed Special. Jim Karen, Morgan Stanley, Kathy Jones, Charles Schwab, Matt Lazzetti, Deutsche Bank, Diane Swonk, Andrew Hollenhorst, Greg Peters and Jim Bianco tomorrow.